I'm hearing like this static.
Check, check. 1, 2, 1, 2, 1, 2, 3, 4. Thank you. Thank you.
Hello, everyone. Okay. Thank you so much for coming to the conference day 2. Your lovely faculty organizers, Pablo and Vivian, have given me the floor to kind of welcome you in. Also take some time so our AV crew in the back can get the best shots in for our presenters. As you have seen, we do have breakfast and coffee in the back. That will be available up until lunchtime, which is at 12:30. Everything is in this room, so we're here. Make yourself at home. We're in it for the long haul. For those of you that are presenting, you do have your clicker and it is relayed to the back. So if you could actually kind of angle the clicker this way, that will be helpful for our AV team. It has been a pleasure to meet you and to learn a lot about these economic principles that I don't understand. But I know that you do, and you've gotten a lot out of it. So without further ado, thank you so much for coming. Enjoy yourselves, eat, have coffee, take notes. I'll pass it over to your chair. Thank you.
Okay, great. Thanks everyone for being here for the second day of the conference in honor of Martine. We've heard a lot from Martine's former students, but I thought I'd just say something as a colleague of Martine's. I wanted to just say thank you to Martine and to Stephanie for being fantastic colleagues. I appreciate all of the work that they do for macro in the department. Within the last couple of years, especially once I became senior, I really feel that the three of us are team macro fighting against the tyranny of applied micro within the department. No, I really want to thank them for being such great public goods providers, for being amazing mentors to their students, and for being extremely supportive colleagues. So thank you, both Martine and Stephanie. Oh yeah, and now we have Enrique Mendoza.
Well, almost. I guess I need my, oh, there we go, great. Well, I should say thank you again, Martine, thank you again, Stephanie, and happy birthday again, Martine, and also recognize the great labor of Vivian and Pablo for organizing this conference. Really, thank you very much from my face. And also to Stephanie, so I'm sure I said enough yesterday about how I think of the two of them as one, and I really admire both of them and what you have accomplished together. So I'm going to present some joint work with Vincenzo that has been evolving over the last 18 months or so. And it's a story now that has to do with reserves. And we often think about international reserves as something that is good for many emerging markets to have accumulated. So you can think of this paper as kind of thinking about reserves as the movie of the good, the bad, and the ugly. So I'm going to show you the good, I'm going to show you the bad, and then I'm going to show you the ugly of the accumulation on reserves in emerging markets. So let me start with a plot that we saw some of this yesterday. It shows you the accumulation of foreign exchange reserves in both advanced economies and emerging economies since the 1990s. So we're going to be associating a lot of what we say with the period of financial globalization, which broadly speaking is from 1990 to 2020 in our sample period. So what you have in red there is the accumulation of foreign reserves as a share of output across the emerging markets, and then in blue across the emerging advanced economies. So there is a modest increase in advanced economies, but the large chunk of the increase comes in emerging economies, and of course the largest chunk of that comes from China. But even if you go beyond China, there's very few emerging markets where the increase in foreign exchange reserves has not been sizable. The median is about 10 percentage points of GDP. So this has been a very important phenomenon, clearly, at least for the first 20 years since 1990. And it sort of accelerated sharply. We also know this from various narratives after the sudden stops of the 1990s. Another important part of so you can think about this as a surge in demand for risk-free assets, right? That's also part of the narrative, the story about the excess demand for risk-free assets, or the global saving law. It has many names. But you also think about the supply. So you think about the supply when you think about the, I think I broke it already. Oops. Now I don't know what there we go. Oops.
I think try pointing to the back.
All right. Oops. Well, this is the strangest clicker I ever seen. Oh. All right, there we go, finally. Oh, this is like a Mike was talking about yesterday. Someone tweaked, now I know what. Okay, so this is the thing about the supply. So this is the supply public debt by advanced economies. And here what you see is a story that's kind of symmetric, but it starts later, right? So you have this large increase in the supply of public debt of advanced economies, but starting in around the time of the global financial crisis with all these fiscal assistance packages and then with the COVID. So it's a sharp increase in the supply of these risk-free assets. So there's a story about surging demand, which we're gonna focus a lot on, and there's also part of the story that has been a surge in supply. So many of the things I'm gonna tell you about have the opposite result if you think about this from this side relative to the increase in reserves. So I'm not gonna elaborate on the details of the two because they're sort of symmetric, so I'm gonna focus on the issue with reserves. No, I gotta continue, you can ask me later. What's the GDP? Yes, they both, yes, man, yes. I moved on. So yeah, these are all shares of GDP, and they're GDP weighted. So yeah, you were worrying about it. They're in dollars and GDP weighted. But so you can we look at this in different ways. You can look at doing it as a share of world GDP. Then it's gonna look like there's not as sharp a decline after the peak in the global financial crisis. You can also do it without waiting. But the general method, there was a large surge in foreign reserves between 1990 and 2009. It's pretty clear no matter how you define it. The magnitude will be different, but the overall message will be the same. So the two big questions that we wanted to ask about these two observations. The first one has to do with the credit market implications of this. So in particular, I don't know which one to look at, there's so many. The effects on the world interest rate, the effect on the credit to the private sector in these economies, and the effect on leverage. And then the second question related to the first, which is what have been the implications for the volatility of financial markets, credit markets, and what have been the effects for macroeconomic volatility, in short, for output volatility. So here's what we're gonna do. We're gonna look at the theoretical and quantitative predictions of a framework in which there is going to be a connection between these two things, between the determination of the world interest rate, credit to the private sector and leverage, and the volatility of financial markets and macroeconomic volatility. And the idea is essentially to have a setup in which there is private debt. Private debt is issued by agents that can default on it. And there's going to be an ingredient that seems reminiscent from the self-fulfilling crisis model, so the sudden stops for that. And there is also a productive use to these assets. So these assets, you can think about them as in the old models of inside money, where we used to put money into the production function. Or you can think about them, as we'll do here, explicitly with a form of working capital. The point is that these debt instruments have a productive use. They can be used essentially as inputs. So the result of this is going to be basically three main things that I'm going to show you. First is that there has been a sharp increase in volatility, that this large increase in foreign reserves, even when you take into account that there has also been a large increase in the supply of public debt, putting together with two other ingredients that are in our setup, which is the growth in productivity and the changes in the financial market structure, end up predicting that there is a significant increase in output volatility. So volatility, to put it in a quantified model, increases by a factor of 4 between 1990 and 2020. If you look at the implication of just the increase in reserves, so we're going to do these counterfactuals, we're going to shut down the other mechanisms and just capture the effect of the increase in reserves. The effect that you will see is obviously that it will contribute to reduce the world interest rate. And then through the lens of the model, the reduction in the world interest rate will result in an increase in private sector credit globally and an increase in leverage an increase in leverage globally as well. And the result of the increase in leverage is going to be that this crisis that occurred because of the default on the private debt create higher macroeconomic volatility. So I'm going to go through the mechanism by which this occurs. And then I'm just going to keep saying that the opposite happens when we do the counterfactual through the public debt. So the opposite logic applies if you think about the increase of the public debt. The public debt of the advanced economies. We're thinking about reserves essentially as purchases by emerging markets or the public debt issued by advanced economies. Okay. You see that in the model in a second. So what's the intuition for the results? Well, again, I'm going to focus on the reserves, and then for public debt, just assume it's the opposite. Okay. So what you will see is that, well, like I mentioned, it's an increase in the demand for risk-free assets. That's going to drive up their price. It's going to reduce their yield. So the world interest rate will be exerting downward pressure on the world interest rate. The lower interest rates is going to incentivize private borrowing. And the result of this is going to be that when there are financial crises, there is going to be a larger redistribution between savers and borrowers. And because these assets have a productive use, that redistribution has macroeconomic consequences. And the opposite happens when you look at public debt. So I'm going to talk about the model and then show you some of the quantitative results. And then we're going to do an extension because some of the comments that come up first is, well, you can think about the accumulation of reserves as a purely exogenous phenomenon. So we just grab it from the data and put it into the model, which is the first part of what I'm going to show you. And then the second question, maybe, what if these reserves have actually a use that the government can actually use them to provide liquidity, which is one of the rationales that we give for why these countries accumulate so large stocks of reserves. So the last thing that I'm going to show you is when we have this kind of formulation where emerging markets governments can use the reserves to effectively in the model bail out the debt holders when there is a default by the borrowers.
Like a default.
So it's a two-country model. So it's going to be what I think broadly about country or region one. That will be the advanced economies, country or region two, that will be the emerging economies. Within each country, there are three sets of private agents. There's going to be producers of intermediate goods, and these guys are going to be the net borrowers. Then there's going to be producers of final goods, and these guys are going to be the net lenders. Now, you can think about this more generally. So in the paper, we go through the interpretation that we have. One group of these producers are producers that have tangible capital, that can be collateralized, and these guys are going to be the borrowers. And the other groups of producers do not. So they use these bonds because they give them productive use. So those will be the net lenders. And then there's going to be households, and the households are to close the model. So these guys are going to be the suppliers of labor, and they're going to be the owners of the firms that produce inputs. So we're going to think about finite good producers as entrepreneurs, so they're going to have their own preferences. And then households will be the suppliers of labor, and then they own the producers of intermediate goods. So they're going to collect the dividends that producers of intermediate goods generate. So to start with the simpler part, this is thinking about reserves and public debt. So just for notation, FX is going to be foreign reserves, and DP is going to be the public debt issued by advanced economies. So we're going to ignore public debt issued by emerging economies because we're going to think of it more like a defaultable debt. So you want to kind of sum it up into what's going to be like the private debt that is defaultable. That's fine with us. So the government budget constraints, so the two regions differ only on that, in that we don't have the issuance of public debt as a risk-free asset by emerging economies. So there's going to be the accumulation of reserves, there's going to be the issuance of public debt, then there's also going to be lump sum taxes or subsidies that are levied on the households. And you see why, I mean, particularly when we get to the bailout stuff. So now the important part are these three ingredients, the borrowers and the lenders in particular. The households are a bit of a side issue, but the borrowers and the lenders are the key to the story. So borrowers are essentially the producer of intermediate goods. They produce intermediate goods with a standard Cobb-Douglas technology. And capital, we're going to keep things very simple. So it's going to change over time, but exogenously. And we're going to do this by tracking it to the data. So we're going to input the evolution of capital in the two regions as we deducted from essentially national accounts and creating capital stocks by perpetual inventories. Perpetual inventories. And then these guys are going to have profits that will be generated by the difference between the sales that they do or these inputs to the final goods producers and the wages that they pay. But what's important about these guys is that they can borrow. So the debt that they incur in period T-1 is going to be essentially a non-state contingent ex-ante non-state contingent bond, which they sell at a price QT minus 1. So the amount that they borrow is DT, the resources that they generate by borrowing is the product of the price times the debt. When it comes time to repay at AT, the contracted repayment is DT, but they might default. So the actual repayment can be a fraction delta of the repay. When is the fraction delta going to be less than 1? Well, it's going to be less than 1 when the debt exceeds the liquidation value of the capital. So this little L that you see in the slide, think about it as the liquidation price of capital, and L times K is the liquidation value of the capital. Now, there's a long and a short way to think about this. So the short way is you can think about this liquidation value as being a stochastic variable that can take a value of 1 with probability 1 minus lambda, and a value kappa, which kappa would be lower than 1, which will occur with probability lambda. And then, so we put this in red to denote this is going to be the first time varying shifting when a variable that I was referring to earlier as characterizing the structure of financial markets. So think of this as a shifter of the supply of debt. The higher kappa, the more issuance of debt capacity these borrowers have. So the idea then, I said this is the short way to do it. The long way to do it is to think about this as a self-fulfilling model of financial crisis, and then you can get a sort of micro foundation for where this kappa comes from. And the idea is that you can think about the fluctuations in the liquidation value of capital as resulting from these self-fulfilling drops in the liquidation value that are going to be driven by a sunspot variable. So basically, when this epsilon takes the value of 0, there is going to be a self-fulfilling market freeze on the market of the liquidation capital, the liquidation of the capital that's liquidated. And when the epsilon value is equal to 1, the value of the liquidation capital is going to remain at its normal level. But it's a little bit like the Kolkiho class of self-fulfilling models in that it's not entirely a sunspot. You need to have the economy sufficiently leveraged, or the borrower sufficiently leveraged. So it needs to coincide that you do have the realization of the sunspot variable, and at the same time that it coincides with the borrowers having more debt than the liquidation value of capital in the case of a default. So you need those two ingredients. There will be a market freeze only if the debt is higher than the liquidation value of capital and the realization of the sunspot calls for the equilibrium where the price drops to be the one where the market coordinates. So I'm going to take the short version of this, but there is an appendix in the paper where we get the micro foundations for this work. There's also a way to kind of pin down how much debt these borrowers take. And the way we do this is by imposing a convex cost of borrowing. So whenever the debt is going to be higher than the liquidation value of capital, there is going to be a convex cost incurred by the borrowers to contract that debt. And the point of the diagram here is just to show how this kind of gives boundedness to the debt decision. And it also helps us pin down the portfolio when the borrowers are actually borrowing, because they can choose between these alternatives. So you have two standard first order conditions. The first one is obvious, it's adjusted demand for labor from the marginal product. And the second one is the Euler equation for this debt. So then you can see clearly what the role of this cost is. And you get this function phi, and it's 2 points to observe here. One is the interest rate. So the interest rate, when we use this R bar, what we think about it is sort of the mean return or the expected return of a diversified portfolio of this debt. So you can think of this as we're going to call the market interest rate in the economy, or the world interest rate in the two-country model. And then there is going to be this term that exists because of the convex cost, the capital phi. And this capital phi is increasing on the leverage ratio. And that's going to result in an increase in supply curve for the debt. So you're going to get that the issuance rises as the interest rate falls or as the price rises. So that's the side of the lenders. Okay, so the important thing here to remember is this kappa parameter that drives the demand for these assets. And then, oops, I keep getting the wrong button. All right. So the lenders are essentially going to have logarithmic utility. So think about this as entrepreneurs I was mentioning. They go and operate a linear production technology. So there's a productivity parameter. I put it in red. This is another shifter of the model to capture the diverging growth rates or the different growth rates of emerging versus advanced economies. We're going to create solo residuals from the data and use them to capture the differential growth patterns of the two groups of economies. So that's going to be also a shifter. Why is it a shifter in this model? Well, because again, these are productive assets. So we're going to have like a working capital structure So when productivity is growing, firms are going to demand more inputs, and with these working capital constraint binds, the productivity growth is another driver of the demand for financial assets. So here you have the standard setup for this linear production technology, the profits of these producers of final goods, and then the working capital constraint. So these firms need to have assets for a fraction 5 of the cost of the inputs that they buy. Now you may look at it at first and say it looks reminiscent of the working capital models that we were talking about yesterday, Newmeyer, Perry, and Uribe Yue. It's a little bit like that, except you don't see the borrowing cost explicitly. Now, it's also important to mention, we think about this very broadly. So of course, literally when you look at it, it's a working capital constraint. But we think about this, think more broadly about the different roles that by these firms that do not have tangible capital, different things that they can do because they accumulate a lot of assets, a lot of cash. They can use them as we do here for trade-off productive use, but they can also be of use to them in the labor market, say for hiring skilled labor, for presenting the quality of their firms and so on. So the important thing is you're going to have a convenience yield. Where do you see the convenience yield? Well, you see the convenience yield in that if the working capital constraint does not bind, so another contrast with the previous literature is this is occasionally binding. So if productivity is relatively low, the constraint may not bind. When the constraint does not bind, the model has much less action, and profits of these producers are 0. When the working capital constraint binds, the price is going to drop. Sorry, that's going to be when the crash occurs. But when the working capital constraint binds and the price is going to drop below the productivity, that's going to generate positive profits for these firms. So in other words, they will hold these financial assets that were issued by the private borrowers of their country and by the government, but the yield that they obtain is effectively higher than the yield of the bonds, and is higher because of this implicit convenience yield. Yeah, thank you. So what you have here is, so what's the post-default financial wealth? So at the beginning of the period, you can break the setup into like 3 sub-periods. In the first thing that happens is the borrowers decide whether they default or not. When they default or not, then you have, they decide to default or not, then you have the realization of the post-default financial wealth. So these guys are going to hold the bonds issued by the private sector of the 2 countries, and they're also going to hold government debt. These are not defaultable, but these 2 are defaultable depending on where country 1 defaults and country 2 defaults. So once this decision is made by the lenders, they can look at the post-default, the borrowers can look at the post-default financial wealth, and that's going to affect the productive capacity. So that's the engine or the mechanism that drives a lot of what happens with output volatility, is when there is defaults from the private sector in a particular country, it's going to create a redistribution of wealth from the lenders to the borrowers, but that has an effect on output, because then the lenders will contract their output, their demand for factors of production, and that will contract the supply of final goods. Okay, so that's, you were looking for where the standard working capital condition will look like. It will be right here. This will be the marginal product of the inputs that these firms demand. This will be the marginal cost, and this is where you can think of as the financing cost, where this parameter here represents the multiplier on this working capital cost. So if the working capital constraint binds, that will be the demand for assets, and this is the point I was making. It will depend on what the post-default wealth of these entrepreneurs is going to be. And then because we have a log utility, you get this fairly familiar setup where these agents will consume a fraction 1 minus beta of their wealth. Then they will save the complement, and the complement is going to be divided over the 3 assets according to this portfolio shares theta, and the portfolio shares are basically going to arbitrage returns, recognizing that these are defaultable. The 2 forms of private bonds are default. Okay, so I should speed up. So the household, like I said, only determine the labor supply so that we can pin down the wage rate. Let me move quickly through all of this. So what we're going to do is we calibrate the model. The calibration is fairly standard, except for this curvature of the cost. We do some sensitivity analysis of it because it's going to matter for some of the results, and we don't have very good footing of what to pin it down. And then we're going to construct these quantitative experiments by first saying, well, there are these exogenous drivers. So you have the evolution of reserves, the evolution of the public debt, the kappa that drives the supply of private debt, the phi that drives some of the demand of private debt, and the productivity, which also drives the demand for private debt. So we have these parameters we are going to, it's kind of similar to doing a particle filter or a Kalman filter, but our model is so simple that you can actually almost do it with a set of equations that you can solve quite easily. And that's why you have the linearity and the non-linearity and the separability. So we're going to take these three things from the data. That's from the pictures I showed you at the beginning, the changes in reserves, the evolution of reserves from 1990 to 2020, and the public debt of advanced economies. Then, as I mentioned, we're going to construct the productivities with solid residuals. There's some story there, but I'm going to skip it. And then the interesting part is how do we construct the evolution of these parameters? What we're going to do, and this is where you're going to see what I was saying is kind of similar to what you will do with a Kalman filter, is we're going to have 4 targets from the data. We're going to say there is a private domestic credit in advanced economies, which we take from the data. There is a private domestic credit in emerging economies, which we take from the data. There's the net foreign asset position of the advanced economies, which we're going to take from Lane Milesi, and the world real interest rate, which is the treasury bill, the 3-month treasury bill. And then you also need to take a stance on the first part is when there were financial crises, and we're going to say in this setup, there's going to be one in 2009 for the advanced economies, and there is going to be 2, one in sort of the 1990 sudden stops for the emerging economies, and then in the global financial crisis. So the construction of these things is easy to identify. This is the data, so that's private domestic credit, the NFA, and the world interest rate. So observe what I mentioned earlier, is the sharp drop in the world real interest rate. And then how we identify it is essentially this 2-country diagram. In the model, you can almost separate it, block recursively, period by period. So starting from the beginning and given initial conditions, you can solve period 1, taking that solution, you can solve period 2, and so on and so forth. So what you have here is how a summary of how the identification works. So here you have the supply of assets and the demand for assets with the shifters that I mentioned, the kappa and the phi. That's for advanced economies. That's the emerging economies. So in the initial equilibrium, you will have that the net foreign asset position of one country has to equal the negative of the other at the equilibrium interest rate. So the way we identify these things is we have these 4 observations. We have private domestic credit in advanced economies, private domestic credit in emerging economies, the net foreign asset position, and the interest rate. So with those 4 observations, we position the kappa and the phi of each country so that these curves cross where they need to cross in order to match those 4 observations. Okay, so this is the construction of this financial variable. So what's important to observe is on the side of the phi, you have that this grew in both groups of countries. So one of the important drivers of the growth of private credit that you saw in the data, according to the model, is the increase in this need for financial assets for productive use. From the side of the kappa, what you see is kind of hovering with volatility in advanced economies and this sort of slow but growing pattern for the emerging economies. So that is telling you that the capacity of these countries to issue debt is increasing over time, but that the demand for these productive assets is increasing worldwide. So then for volatility, I'm going to go very quickly. What we did is we're going to construct these repeated simulations, 10,000 periods, and then 10,000 model simulations over the same 1990-2020 period. For each of the simulations, we're going to use a time series of the data that I show you for reserves, the data, the public debt, the data we constructed for the phi, the kappa, and the set. And then for these simulations, we're just going to draw random realizations of these episodes. So there is going to be some episodes of financial market crisis and some episodes that are not financial market crisis. And then we're going to compute for each of these 10,000 simulations, we're going to have a cross-sectional distribution of the output, and we're going to look at the average, and then we're going to look at the 5 and 95 percentiles, and we're going to measure volatility at the difference between the 95th and 5th percentile as a percentage of the mean for each of these cross-sectional samples at each of these periods from 1990 to 2020 in the 10,000 simulations. So at each date, we had 10,000 cross-sectional observations over which these are computed. All right, so here is the first point. You ask the question, how much did the change in reserves contribute? So this is a counterfactual where we keep reserves constant. It's like saying keeping them at their balanced growth rate. And that's the curve in red. And blue is the actual baseline model where all these changes are occurring at the same time. So what you see is the point I was making earlier. Essentially, the volatility of emerging markets is higher if you allow the reserves to increase as they did in the data. If you take out the growth in reserves, the volatility is lower. It's what you see in the red dashed line. Also, the point I was making earlier, if you just focus on the blue line by itself, you see the substantial increase in volatility in advanced economies and in emerging economies. That's what I was saying earlier, by a factor of 4. So volatility increased substantially. If you were to take out the increase in reserves, it would have increased less. Why would it have increased less? Well, here is the answer, because the interest rate would have been higher, and the higher interest rate would have resulted in lower effective leverage, which is what you see down here in the red. And with the lower effective leverage, you would have had less volatility, because you would have had less episodes in which there would have been this financial crisis, leaving everything else the same. Okay, so here is a counterfactual where the only thing we changed was keeping constant the foreign reserves at the balance growth. Same thing with public debt. I'm going to skip it. Like I said, it's the opposite. You will get the opposite message. The increase in the public debt contributes to reduce volatility, because it would have contributed to increase the interest rates, and with the higher interest rates, you would have had lower leverage. And with lower leverage, you would have had less volatility. So very quickly, I go through this point. So what if you allow the emerging markets to have these reserves, and then the government, at the beginning of this period 1, when there is a default, it can intervene and use those as reserves to make whole some of the losses in the wealth that these entrepreneurs are suffering because there were corporate defaults. So we're just going to adopt this rule where we provide this bailout, and look at the way we did it is the bailout you can lose is going to be for a fraction alpha, and the fraction is also going to depend on how many reserves you have relative to the losses that the private sector has suffered. So it's always going to be some fraction, and if you have a lot of reserves, this is going to be like a complete bailout, if you had a lot of reserves. And then what you're going to have is you have to change the government budget constraints to allow for that bailout to occur, and you can think about an implicit subsidy rate, which will be like the amount of bailout that you provide according to this rule relative to the losses that are being suffered because of the private defaults. So here is what happens. Well, obviously, since the advanced economies have very few reserves relative to the size of their economies, it doesn't really make that much difference to them. Now, you could say, this is easy to fix. Think about this now as issuing public debt. So instead of the bailout being made by reserves, advanced economies, you could think about this kind of like quantitative easing by issuing more public debt to provide this liquidity. But in emerging markets, what you see here is for three values of the alpha, 0, 10%, and 30%. And you see the effect of these bailouts are reducing volatility. So you would say, oh, that gives the incentive. So if I think about them acting atomistically or unilaterally, these countries will want to accumulate reserves because it will give them the ability to provide these bailouts, which will give them the ability to reduce macroeconomic volatility. So the last thing then that I will say is to think carefully about what we're saying here. So there is a message that is telling you, well, using the reserves can help you reduce the macro and the financial volatility if you think about it as a single country. And indeed, we have other angles in the literature that provide arguments for why reserves can be used with this purpose in different mechanisms. But the point we're trying to make here is that if you have a collective of countries doing it at the same time, so think about the group of emerging economies, what we're showing here is that there are general equilibrium effects. Those general equilibrium effects reduce the world interest rates, and through the lens of our model, that reduction in the world interest rate can lead to increased leverage and can lead to increased macroeconomic volatility. So that's what I was saying. There is the good, there is the bad, and there is the ugly. And the ugly thing also is that you have this improved stability of the countries that accumulate the reserves, but you also have the increase in volatility that I show you happen in advanced economies, even though they're not the ones that build the reserves. So you have this spillover. You can think of it as an externality, which is affecting the countries that did not accumulate reserves. So that's the last point that we have, is that you can think of this as an externality that could lead to the overaccumulation of reserves, because acting atomistically, the individual country is not internalizing that there is these global effects that can increase global volatility or global instability, even if you're improving domestic stability or reducing domestic volatility. So I'll stop here.
All right, thank you very much. It's a great pleasure to be here to celebrate Martine's birthday. You know, given my lack of gray and my full head of hair, you'd be surprised that we're roughly the same vintage. And we work on very similar topics. So I've learned a huge amount from him. And we have papers that disagree, but the disagreements are always scientific, and that's the kind of thing that you learn the most from. And then after last night, I felt even better, because it means Stephanie and I have more in common. So, anyways, I'm happy to be here. My slides are coming.
Yeah, it's a bit of a delay.
Perfect. All right. So which is the one that changes the screen, and which is the one
Forward
that...
this way, backward.
Okay.
Yeah, and then the little dot is...
Okay, perfect. So I'm happy to discuss this paper by Enrique and Vincenzo. So let me just give you a thumbnail sketch of what they do, and then I'll get to my comments. So this is the big increase in foreign exchange reserves, particularly in emerging markets. And we kind of know what happened here. There were these big emerging market crises in the 90s and 2000s, and emerging markets wanted to build up a buffer stock against these kind of hot capital flows. At the same time, the public debt of advanced economies, so think about the US, the UK, has increased. So this is kind of, as Enrique said, there's a supply and demand going on, but the demand for safe assets is kind of dominated, if you think about it that way, and the yield on these things has fallen. Okay, so this is the savings glut, et cetera. And then the other piece of the motivation is this increase in leverage in the, I'm going to focus on the emerging markets, right? So companies there start levering up, okay, over the same period. So this is a paper to put this together and kind of think through it. So I think it's a bit provocative. So the accumulation of reserves in emerging markets, which we all saw happening as a response to these emerging market crises, and I think the conventional wisdom was this was a prudent development, is actually increasing volatility, okay? And then increase in the US debt and other advanced economies stabilizes the region. And then the higher world interest rates would be good for stability. So these are kind of, I think, provocative. I mean, the increase in US debt, there's a shortage of safe assets. There's many papers that say that increasing that is a good thing. I recommend one by Christina, which is very good, on Pareto improvements, but I think for emerging markets, this idea that these reserves are bad for volatility is the provocative thing. So let me just give you a quick overview of the plumbing. So the entrepreneurs, they have log utility. They're risk averse, they want to save. They save in risk-free and risky bonds, and they have some wealth M. They have this very simple technology. They buy in intermediate inputs X and they produce Y, the final good. And then they have this wealth constraint, right? That the amount of stuff they spend on intermediates has to be less than some multiple of their wealth, okay? So this is the key friction. So you can just kind of rearrange this. I'm just going to assume this thing binds, which is the interesting case, and you get this demand for intermediates that's a function of wealth, okay? And then if this thing binds, there's going to be some downward pressure on the price because the demand is going to be restricted, and there's going to be a rent that these guys earn or profit these guys earn. So the lower the wealth, the lower the price of these intermediate inputs, the higher the profits go to the entrepreneurs, but the lower the wage of the people that produce these intermediates. So that's the other half. So I'm just going to combine the intermediate good producers and the households. They're really the same. They have these quasi-linear preferences. So they have a standard Cobb-Douglas production function. And in an equilibrium, this term here, the Z times L, this is the disutility of labor for them, is going to be proportional to the wealth. turns out everything is kind of proportional to the wealth. Everything scales up. And so this is going to lead to a lower M, lower wage, lower labor supply, and lower output. So output is going to be a function of wealth. Okay, so this is kind of, this whole block is basically to get to this point where the amount of stuff produced is a function of the entrepreneur's wealth. Actually, the utility of the households is proportional to wealth, and if you can get the parameters right, it actually makes sense for them just to give the entrepreneurs $1. They'd be better off. So it's one of these models where the dollars are kind of stuck in the wrong hands in some sense. Okay, then the households have a side hustle. They're linear in consumption. They're the natural insurers, natural lenders, natural providers of safe assets, but they have two problems. One is they have a convex cost of issuing these assets. So what does that mean? They're only going to do it if the competing safe asset, which is the US Treasuries, has a high enough price or a low enough return. So when that happens, they get in this business. Okay, so that's the first element of it. The second problem with the households, even though they're linear, they lack commitment. So if this lambda shock goes off, they don't pay the full amount, and so this makes these bonds risky. Okay, and when that happens, they don't pay the entrepreneurs what they're owed. M falls, output falls, and bad things happen. Okay, so putting it all together, the demand for reserves goes up, the US Treasury rate goes down, these households get into this business of issuing risky claims. The entrepreneurs need to hold something for savings, they end up holding this stuff, and then you get this volatility. Okay? And it's obviously the reverse if the US is providing more safe assets. Okay, so that's the plumbing, it's very straightforward. My first comment, how to model the link between the world interest rate on safe assets and output in emerging markets. So Enrique and Vincenzo, as I told you, they put wealth in the production function. Notice the interest rate doesn't show up there at all. Whoops. But the interest rate shows up in kind of what they hold in their portfolio and how much they hold. And through that channel, the volatility of wealth goes up and the volatility of income. Fabrizio and Andy have an alternative view. There, if you work through their model, the interest rate shows up in the production function. A low interest rate means that it's cheaper. They have like a cash in advance or a wage in advance constraint. It's cheaper to hire workers. You're going to hire more workers. You're going to produce more. So a low interest rate means more output. And they have some very nice plots to motivate this. So this is Argentina. The correlation of interest rates and output is very negative. So when interest rates are high, output is very low. So Argentina is the classic, but they have a whole bunch of countries. Brazil, Korea, this correlation is pretty robust. Okay. Then I would be, given the occasion, I should mention Martine and Vivian have a very nice paper, kind of disentangling who drives whom. And they argue that the shocks to R star drive a lot of emerging market business cycles and in the direction of a Neumeyer-Perry kind of mechanism. So low interest rates are a good thing. So I think if you're going to say the opposite, I would like to see a little bit more evidence that this is going on, right? There's a whole bunch of evidence showing the Neumeyer-Perry kind of direction. It's a little bit tricky because the panel regression approach that we typically use isn't right because of this spillover. It's China's holding of reserves making Mexico more vulnerable to crises. So it's a little bit tricky. But, you know, we have these measures like what Simon Gilchrist and Vivian have done on distance to default or corporate spreads. Do these things move in the opposite direction in emerging markets relative to the risk-free rate? And has there been some evidence of a rise in global volatility in any asset prices? That would be nice. So for me, this struck me as like a claim that I just didn't see in the data. But you know, I don't get out much. So when I really want to know what's going on in the world, I call Gita. And I was surprised that she has something that kind of agrees with these guys. So what do I know? So she has her argument that what she's worried about is that the decline in U.S. interest rates is driving corporations and emerging markets to borrow more in dollars rather than in local currency, and that has its own risk of when the devaluation comes, there's a balance sheet risk. And so this is her plot. The dollar liabilities on the horizontal axis and the central bank reserves on the vertical axis, and this is a panel, so it's a scatter plot, but she shows this positive correlation and worries about a similar mechanism that these things are driving each other. Okay, and she has two-way kind of mechanism. Okay, comment 2. Is private debt the problem in emerging markets? So Manuel and I have a line that we argue the opposite. It's the governments that are the problem, not the corporations. Even with the extension with the government bailouts, it mitigates this problem, but there's still an increase in volatility. Our view is, what if the government is the source of volatility? And, you know, and the way we think about these emerging markets is the government needs resources and it grabs them from the private sector. And that's the risk that they face, this expropriation risk. And if you have more reserves, when something happens, you're much less likely to grab stuff from the private sector because you have these reserves to use it. So in our view, the lower interest rate lowers this risk of default on the government side, lowers this risk of expropriation, makes things safer. Comment 3, there's this Triffin dilemma. I've never really understood what this is, but I remember Emmanuel talking to me all about it, and he and Matteo wrote this nice paper. So I know what their paper does, but they argue that there's some point at which the US debt issuance becomes counterproductive. We kind of go beyond the peak, and US debt becomes risky. And then they open themselves up to this possibility of a Calvo crisis, and that generates risk. So there might be a point in this model, if you put that in, at which point the household's risky debt becomes actually preferable at the margin to what the governments are doing. Okay, but it's very, very interesting, very provocative, and I look forward to seeing more on this. Thank you.
Thanks a lot.
Okay, we have some minutes to take questions, and Enrique can also
Would you want me to
respond.
start?
Sure, if you want.
Sure. Thanks a lot, Mark. Thank you very much. I guess I go with Gita this time. Now, a couple of quick things. So, he was very kind to share the slides a little bit ahead of time, so we had time to think about some of these things, so it's not like I'm just making this up. The point about the standard working capital models is a good one. So at the core, the models are not that different. In the standard model, this is a kind of a within period loan, so you borrow, then that's why the interest rate shows up. So you have the standard condition equating the marginal product to demand the input with the marginal cost, and the marginal cost is the fraction that you need to pay with working capital times the interest rate. So that's the financing cost. And when I show you, what you have is the same fraction of what you need to pay with working capital, but here, instead of being the interest rate, it's kind of an implicit cost, which is the tightness of this working capital constraint. So if you take that sort of mapping and say there's like an implicit domestic interest rate to the working capital, which is that multiplier, the models are not that different. Now, they are different in what they're finding, right? Because we have this class of models where the interest rate is good versus where the interest rate is bad. High interest rate or the reserves is good or is bad. Now that it's interesting too. So if you take the baseline of our model and you just ask the question, what has been the implication in general equilibrium? Because what happens in the standard model, so the two types, the Neumayer Perry and the Uribe-Yue, is that the interest rate is exogenous. So what happens in this model is that the interest rate is endogenous. So you have the force that is driving the increase in the demand for the risk-free asset that's pushing the interest rate down. So if you look at the baseline in these blue lines that I show you, pushes the interest rate down, and it helps output grow. So you look at it from that perspective, there is in the model that the interest rate falls and output growth. So you just look at mean output, you say that's good because it's driving output up. So that sense is not that different. But he's right. In the other sense, when you look at the volatility, so instead of looking at what happened to mean output as you move, you're looking at the volatility between the 5th and 95%. That is growing. So in that sense, we have this prediction that the interest rates are bad for output. But the message is, in our model, it happens because of general equilibrium, because of the general equilibrium implications of the interest rate changes. So I think at the core, the mechanism is not that different, but what it's doing here is different. So I should stop here in case someone else has some comments.
Fabrizio?
That's a fundamental difference, right? I mean, if you get wealth, for us, entrepreneur borrows, so interest rate are high, entrepreneurs are in trouble. In your world, they save, and they got interest rate is higher, and the entrepreneur are happy. So, you know, in a way that, and setting aside the general equilibrium, I think is more fundamental. I'm not so sure what's the right view, but I think that's a key difference.
Yeah, I mean, there's a notion in which it's inside money. So he did the right thing. Previous version of this work, we had put the bonds right into the production function. Then we got all these pushbacks. Apparently, inside money is not that hot anymore. So working capital seemed like wasn't so bad. But the way he put it back is kind of the way it was back in the original model, saying for these kind of companies or entrepreneurs that don't have tangible capital, these assets have a convenience yield, which is what we wanted to push, this idea that there is this role of this sort of liquid assets that goes beyond just the return on the asset.
Wamba? Yeah, so you talk about volatility. How about welfare?
How about welfare? Yeah, so that is a good question. So there's a competition here between two things, right? So again, going back to the baseline in the blue curve, so you have that over time, output is growing, productivity is growing. So you have all this issue with global financial integration is doing the benefit. It's sort of implicit because the accumulation of capital here is exogenous, but you see that that's also driving the decision to borrow of the borrowers in the model. But there is more volatility. So you have the competition between the averages are getting better, but the volatility around those averages is larger. Now, my tendency will be to say that probably you will not get that big a welfare drop, but we haven't done welfare calculations, so I don't know the exact answer. If you condition on just the volatility, it will look worse, but the two come together.
Christina?
Very interesting, Enrique. So in the United States, there is, the business sector has a lot of financial assets. I think like half of a GDP of financial assets, but also half of a GDP of debt. And I always had a hard time thinking about, having simultaneously financial assets and debt, but certainly financial assets are important. And, why they hold so many assets, I think you're giving us a possibility there. Well, a question is about, is it similar in emerging markets? You have some data that where, firms are holding so much cash or financial assets that would, going back to Mark's point to, just to sort of, bring more data into the table for that point. Correct. That's number one. Second, in your in the model, of course, low interest rates happen simultaneously with high leverage. And the high volatility is a sort of result, is in general equilibrium, what happens in those circumstances. But is it the leverage or is it the low interest rates that is giving you the higher volatility?
I see. Yeah, it's both, right? Because the leverage is high. So remember, you need to have the debt exceeding the liquidation value capital for the sunspot to trigger the crisis. So the volatility comes from the fact that the more you have the leverage growing, the more, to be very technical in those simulations, as you're drawing the values of the epsilons, you can be more frequently on these fat tails. But the reason you have that high leverage is because the interest rate is falling. So it's because that's part where it's a two-country general equilibrium model. So the leverage is growing because the interest rate is falling, or you can say also the other way around. It depends on the way you want to think about it. But the other point you started with is also true. It's very heterogeneous. So the firms that have lots of cash holdings tend to be in the high-tech sector. So that's why we had this kind of abstraction of thinking about the firms. Some of the firms have tangible capital, some of the firms don't. So, but it's not like all the lenders and the borrowers are just like that. There can be also like households that are borrowing for housing. So it's kind of like heterogeneously distributed. And how it goes when you go to emerging markets is also quite different. We do know that there was a surge in corporate bonds. That was observed in this period of the growth in credit in emerging markets. So there was a lot of, but I know less about how they coexist with their cash holdings. It's a little bit like the problem of countries that have large foreign reserves and large external debt that you guys have also studied in the sovereign debt literature. And the one thing I also wanted to mention, so the part about, which is very nice, the connection with the public debt of the emerging markets and the default there. So that's the sensing we were thinking about it as more grouped together with the risk of default that the other private debt has. But we haven't, beyond, but it would be nice to articulate it to say you could issue this debt, but it's also risky debt, the sovereign debt of these emerging countries.
Okay, great. Thank you.
Shall we sing? Happy birthday, Martine. I'm glad to be here. Thank you to Vivian and Pavel for this great program. Just one thing that I noticed looking at the program, and you see it even in this session, is it's so diverse. It's such a global community we have here, and from this panel, it's shaped even by the location of our early education, by where we got our PhDs. We're all over the map, and so it's great to have everybody together and just thinking about these things. We're all shaped by our paths, and it's great when we talk together. So for the panel, great panel. Oleg, everybody knows Oleg, just his own background, BA from Moscow State, PhD from Harvard, Princeton, UCLA, Clark medalist 2022, and I'm just always amazed by Oleg. His clarity of thought is like appreciation of theory and empirics, so we'll hear hopefully some of that. And then Yan, from China, undergrad in Shanghai, then Peking, master's degree, Minnesota PhD, Rochester work, on her side, the work on financial frictions and integration uncertainty, that'll be great in thinking about the questions of this session. So let me, with no further ado, Oleg, it's yours. You have 30 minutes, and I'll be strict.
Thanks so much, Linda, for this introduction. Happy birthday, Martine. I sort of met Martine and Stephanie through papers 20 years ago. So one of the first classes that Gita taught, like in the second year international macro class, I took it in my first year. So this was like first year I arrived, and so she's teaching BKK, Mendoza, Schmidt-Grohe, Uribe. So this were coming like the first week. So then I worked on pass-through. So we had some papers with Gita on pass-through, and I was reading Deep Habits. So Deep Habits was one of the actually first papers that I read in the first couple of years. And so that's sort of through these papers how I know Stephanie and Martine. And then 10 years later, I met them, my first seminar in Columbia. So, I got to meet them, and they were working on pegs and pain. We were working on fiscal devaluations, quite related paper. And so this paper on sanctions, it will have a piece that's sort of related to the pegs and pain, and also more recent of your work on the expert currency controls, right? I want to talk about sanctions and the exchange rate. That's the paper we wrote with Dima. Let me see if I can do this. I'm not sure. Oh, I shouldn't have touched it, right? Yeah, that was a mistake. So this is the Russian ruble US dollar exchange rate. Yeah, here. Oh, yeah. Oh, it's to this. I think it's over there, right? Back there. Yeah. Let me see. And maybe it's with a delay. Yeah. Okay. So until Russia started the war in Ukraine in 22, the ruble was super stable. So it was like a managed peg until 2015. And actually the war in Ukraine really started in 2014, right? 2015, the oil prices collapsed from like the highs of 100 to like the lows of 40. So before oil prices collapsed, ruble was very stable at 30 rubles a dollar. After the oil prices collapsed, it was very stable at 70, 75. And you can kind of see in the beginning, it's like 75 rubles per dollar. Then the war starts in February, and there's like this massive devaluation overnight, essentially, right? So financial sanctions are imposed, and basically over a couple of days, there is a, it goes from 75 to 120, 130, basically, right? So this is massive devaluation. People are like, okay, sanctions are working. Maybe it will stop the war. But then, like 4 weeks into the war, ruble starts appreciating, right? And it appreciated a little bit and then appreciates some more. And then suddenly it goes back to like, very strong levels that have not been seen in 10 years, right? And then obviously people started saying, well, clearly sanctions are not working. We should not do sanctions. And then other people were like, well, this is not a market exchange rate. And yeah, the conference is called emergent markets, but this is like an example of actually what's the opposite of emergent? Rescending. Decline in market, right? And so, well, maybe if it's a rescinded market, it's not a market price, so we shouldn't pay attention to the exchange rate, right? And so there was like a big demand to like figure out what was actually really going on. And, around April, we were working on papers on exchange rate, and we thought, well, it actually fits the model pretty well. And so I'm gonna show you like a teaser picture. So if I can click effectively. I relied on clicking a lot. So around August, we calibrated it, and August is somewhere, where is August? August is like here, right? So what I'm showing you is the calibration of the model out of August, right? The red line is what we did in August. And, I feel like we beat the random walk, in terms of the prediction, right? It's big part of it is luck, right? Like we have one realization, we got to hit that one realization. I'm going to show you a decomposition inside this model of like what the model tells were the forces behind the red line, like how different forces we can decompose, right? That sort of will be a final product. I hope to get there. But the point is that there was a mix of trade kind of sanctions and shocks, policy response and financial shocks, which all together kind of contributed to this dynamics. And in a way, it created a predictable path for the exchange rate, right? And so given this, you can then say, well, which of the sanctions seem to have like the bite on like also the real allocations, not just on the exchange rate, given that you have a model that kind of can rationalize that path. And the story would be that it's a very much still a market outcome. It's a market variable. You can learn quite a bit from its behavior, but it's just an economy under a lot of constraints, a lot of sanctions, a lot of imperfections, and like a lot of policy, including financial repression, and putting it all together kind of gives you a picture of this. So let me see if I can do this. So no, I was going back. Yeah, so behind the model, no. There would be this basic idea that exchange rate kind of is crucial in both markets. It's in the goods and the asset market. And so what would be new about this analysis is that we want to think in the space of currency supply and demand. In standard macro, we typically write models in the space of goods. And like there is goods demand and goods supply, but I think it would be useful here to think in the currency market about the equilibrium. And so you can think about sources of currency supply and exports and foreign reserves as a source of currency supply. And then when you need to buy imports and there is a demand for assets, that's a source of currency demand. And what happens to exchange rate will really like be determined in that market. Of course, the reverse side of that is the goods market, which also needs to be in equilibrium. And that's how we typically do the analysis. But I think here it's particularly useful to actually think from the perspective of the currency market, where all the shocks and sanctions and policy response played out. I should have practiced. Yeah. One more? Yeah. So the model is super simple. I'm going to do the whole model on the on this slide. It goes with a lag, and I pressed too many times, I guess, no? Yes, I want to be here. Okay. So it's a small open economy. I overshot. Let's see. Okay, let's see. Okay, so it's a small open economy with tradable, non-tradables. I'm going to think about Russia as a small open economy. It's big in the oil market. It's small in the financial market. And so, it's sort of interesting to kind of think about what being big in the oil market really means in the model. That's something it seems like we'll have to do in the next version of the paper. But the difference here would be that we'll explicitly model the demand for foreign currency, right? And it's just this very simple tweak. So we're going to put inside the utility function, this is going to be the standard piece, and we're going to put demand for foreign bonds or foreign deposits or whatever it is, but foreign currency sort of liquidity into the utility function. And there would be shocks to that piece, right? The budget constraint is standard. The households need to consume the home good. They want to buy the import good, and they can save in the domestic asset or they can save foreign currency asset, right? And then they get some stream of wages. I'm going to use this utility for kind of calibration purposes, right? And then the rest of the economy is what I call a mafia sector. So the mafia sector is, it's essentially the government sector, but there are firms and financial sector in it. But like if you think about Russian banks, most of them are owned by the government. If you think about oil companies, they're owned by the government. If you think about transportation, healthcare, education, it's all owned by the government. So in fact, it's kind of reasonable to think about all of that as the big government sector with its kind of common objective. So in a sense, whether like $1 from oil sales is in the pocket of an oil company or in the pocket of the central bank, it does really matter, or Ministry of Finance, it does really matter. It's one sector of the economy. It's a pretty good description of how Russian actually economy works. And so let me tell you what's in the budget constraint. So F are total net foreign assets of the country. And then B star, what's held by the households or in private hands, right? And so F minus B are the foreign reserves of the government, whether it's the central bank or Ministry of Finance. And then B without the star is the domestic currency borrowing, right? And so there is imperfect substitutability between saving in domestic currency and the foreign currency because there is this convenience yield from holding foreign currency savings, right? And so households, once the war started, what we will assume is that households really stopped trusting the domestic vehicles of saving and really wanted to go into the dollars. That was a big shock. It's not just the households, it was broadly the whole economy has shifted towards it's like this capital outflow or, like currency demand shock. That you can think about, right? And so on the right-hand side of the budget constraint, there is domestic output, PY. This is like in local currency, in rubles. And then there is the Y star. And so the Y star are the dollar or the euro revenues from selling commodities, right? And then you use the exchange rate to convert it back to rubles. So the government should satisfy the budget constraint in rubles because its commitments are written in rubles to the public. That's the W. Also, expenditure on the war could come there with like a minus G, and you can shock that additionally, but we didn't need to do it. And so the point is that, well, you take as given how much oil in euros you can sell, or in dollars, but then there is an exchange rate which it converts it back to rubles, right? And so one of the shocks would be the Y star, right? Okay, so what I want to emphasize here that there are two different interest rates. So the interest rate that faced by the government, the R, is different from the interest rate in dollars faced by the households. And the financial repression will create a gap between the two. And that's one of the policy instruments, right? The households cannot go directly and use the foreign interest rate. They have to go to the banking system in Russia, and banking, it's part of the mafia sector, right? And so that will give you an interest rate or, implicit or explicit interest rate that's not the same as the R star in the world. In particular, you can come to the bank and they can say, well, I'm going to give you, the money, but you're going to have to pay me the 10% tax. And that's exactly what happened in like March 22 is like there was a 12% tax imposed, right? On like whenever you wanted to take dollars. And so that's part of the financial repression. There were many measures of financial repression that, we can put in different ways in the model. And so, okay, so there is market clearing and non-tradables. So non-tradables are completely boring. And then there is the combined budget constraint of a country. If you sum together the government and the households, you get this in the bottom, you get this very simple budget constraint, that evolution of net foreign assets. Now in foreign currency, it's just net exports in foreign currency, right? It's what commodities you sell minus the imports that you buy, right? And so what the foreign countries can do, they can make it harder to buy imports. That would be the import sanctions, right? And that would be through the P star. Okay, so the full set, let me see if this works now. Yeah, so the full set of shocks, we want to write a super simple model, as you've seen on the previous slide, where we can put a lot of sanction shocks and a lot of policy responses. And so the sanction shocks, it could be about export revenues, it could be about, import, how hard it is to buy imports, or, import tariff it could be. There is a domestic recession potentially. There is this freeze on assets, exclusion from the financial markets, and so on. And the policy response, you can like inflate, you can default on your promise to pay the households, you can do something with your reserves that you have, unless there are sanctions. And there is the financial repression. So we kind of want to discipline this by what we observed in the data and see what the model predicts for endogenous variables, right? And so I have one more slide that will set up the whole thing, and then you can sort of see the results from there. Let me see if I can do this. Yeah, I'm struggling. Okay, if I can, I knew that would happen. Oh, it's different from what I see. Sorry, now I understand. I'm looking here. Okay, got it. Okay, oh, this is so confusing. This is a different screen. Got it. Okay, so there are three equations in the model is super simple. 3 endogenous variables, 3 equations. So the first one is this flow budget constraint of a country. Dima loves colors, and I did not overrule it. So everything in red are the shocks, right, imposed on the country. So for example, if you freeze foreign reserves, it's a shock on F star at time T. You freeze part of the reserves. Y is the export revenues. P star are the import sanctions. And R star is like possible exclusion from the financial market. The blue stuff are endogenous variables that we need to solve for. So endogenous variables will be exchange rate, E, how much imports you buy in different periods, and you optimize, intertemporally, that's the CF. And the private foreign currency savings, that's the B star, right? And so the policies are in orange. So the government can do foreign reserve policies and can inflate, that's the P, and it can do financial repression, that's the R, H star in the third equation, right? And so equilibrium is just, the dynamic solution to the system. When you're in steady state, you can ignore the earlier equation. So it all will be about the budget constraint. And so it's interesting. So this is a lot of the results come from the fact, well, you just have to satisfy the budget constraints. And then prices, including exchange rate, just adjust to make sure that this is sort of consistent with market equilibrium. And so all sanctions that affect the budget constraint in the same way have sort of the same effect on allocations. Right, and that's kind of the core principle here. And of course, when dynamics is involved, then the earlier equation starts being in place. And notice that in the earlier equation, there is the standard part and the convenience yield. And so that would be kind of the crucial idea that when you really want foreign assets, there would be a conflict between people who want to save and people who want to buy imports, because currency is in scarce supply. And so the equilibrium is an intersection of like kind of making happy both the savers. I mean, it's a representative agent in the baseline before I will do heterogeneous agents, but each agent is a saver, and he creates the demand for currency from the second bracket, and a consumer, and it's a demand for currency from the first bracket, and the equilibrium should balance out the two. And so when there is a big demand for currency, which is scarce, it will come at the cost of like buying imports, right? You will be accumulating assets to satisfy the savings side, and this will affect the imports and utility through consuming less imports along the transition path. That's sort of the spirit of the model. Oh, 5 minutes, that's it, oh my God. Okay, so let me show you a couple of things. Okay, so basically, this is just the intuition of what happens from the perspective of the intertemporal budget constraint. Oh, okay, thank you. Can I 10? 10 is okay? 12, thank you very much. Okay, oof. So basically, I skipped the equations. Let me tell you the intuition. So because we discussed this, that it's all about the budget constraint, right? You can tighten the budget constraint by cutting revenues from exports or by making imports more expensive. Allocation will be the same. But interestingly, the exchange rate will have to adjust differently to support this allocation. So Guido and Ivan have this logic from the goods market, and the way they explain the logic from the goods market is like, well, when you exclude a bunch of Italian goods from the possibility to consume, well, now you have all these revenues from exports, but you cannot buy Italian goods. So you have to go to goods from other countries like Turkey and India. But you don't really want that goods given the current prices. So prices have to adjust to compel you to buy them, and prices have to fall. A fall in prices is an appreciation of the ruble. And that sort of explains appreciation. There is the same intuition from the currency market, which I think is somewhat more straightforward. And this is the panel B here, is like, imagine when you do the export sanctions, exports shrink. What it means in the currency market, the currency supply is scarce, the currency that you were getting from exports, you don't have it anymore, right? And so, well, you cannot buy imports, but how the prices would sustain that you cannot buy imports? Well, imports need to become more expensive, and that's the depreciation. On opposite, if you do the import sanctions, well, you cannot buy the import goods. You don't need the currency to buy them anymore. So in the currency market, there is less demand for currency. And so as a result, the two types of sanctions, the shift of the red curve is the export sanctions. It's a reduction in currency supply. The shift in the blue curve is the import sanctions. It's a reduction in currency demand. And that's why you have this, it supports the same allocation in terms of goods, but it requires a different movement in the exchange rate, right? And so exchange rate stops being a sufficient statistic for the allocation, right? Whatever it needs to be to support it, given the policy that was imposed. And because the policy is different, exchange rate moves differently, but it supports the same allocation, right? I mean, it seems like an intriguing result, but if you think about it, it's just a manifestation of Lerner symmetry. And so Lerner symmetry is this fascinating result from 1936. What Lerner symmetry says is like you can do import tax or export tax. You're going to get exactly the same allocation in the end of the day. Why? Because of the intertemporal budget constraint. Your import tax or an export tax do the same thing to intertemporal budget constraint, but the relative movement in prices needs to be different to support the allocation. When you do one, for example, if it's an export tax, well, if it's an import tax, import goods become more expensive. You buy less imports, and you export a lot. But you need to balance the trade. And so by balancing the trade, what needs to happen? Relative wages need to increase. You need to export less in response, right? If it's an export tax, it's the opposite, right? Like you have hard time exporting, you need to rebalance things and wages need to come down. So instead of wages here, it's just the exchange rate that moves, right? But in the Lerner symmetry, it was through relative wages. Amazingly, Lerner symmetry is super general. It applies to a dynamic model, any pass of shocks. It doesn't really require stuff. It's much more general than, for example, Ricardian equivalence, as I'll tell you on the next slide. The symmetry requires that the decline in, exports and net foreign assets or the increase in price of imports are sort of like they do the same movements in the terms of trade. If they achieve the same movements in the terms of trade, then allocations will be the same, right? And that's sort of the spirit of the Lerner symmetry. And so that's sort of the paper over which we met with Stephanie and Martin was the fiscal devaluations paper that we wrote with Gita and Emmanuel, and that kind of like was relying on Lerner symmetry. I realized later that it relies on Lerner symmetry, but it's really the Lerner symmetry in the background of this result. Okay, very good. So I'm going to skip that. What's amazing about Lerner symmetry that it applies not only to some allocations, it applies budget constraint by budget constraint. So if you have heterogeneous agents, it will do the same. And so this is surprising because you think, well, maybe you design sanctions that are particularly hurtful to the government budget constraint. But Lerner symmetry tells you you cannot. It doesn't matter, like even if the government gets all revenues from exporting commodities, still there is Lerner symmetry. You can still go after imports and you're going to get the symmetric thing. So some people took it, it's interesting in this debate, some people took it to suggest that if you do import sanctions, you can relax on export sanctions, that there's some kind of substitute. Well, the point is it's only in the limit that if you did 100% import sanctions, there is no room for it. But actually they're complements, right? Like they augment on top of each other, right? So these arguments that were in the spring of 22, that if you did imports, then all this, dollars that come to Russia will be useless. That's of course a wrong argument, right? The dollars are dollars. You can still buy goods with them, right? You can buy fewer goods, but it's not to say that export sanctions are irrelevant. So there was a big debate on Twitter over that, 2 years ago. Anyways, so how general is Lerner symmetry? Lerner symmetry is super general. It's much more general than Ricardian equivalence. It implies budget set by budget set, but there are limits to it. And so when you read Lerner, it's a trade paper. So he says it needs to be a uniform tax across all goods, right? All goods that you import, all goods that you export. Well, of course, in a macro model, we don't care about the cross-section of goods as much. I mean, it's important when you start thinking you cannot buy from Eurozone, from European countries, but you can buy from Turkey and India. You need to think about that cross-section, and that's a separate interesting question. But in macro, the really important uniformity is over time. And so for Lerner symmetry to apply, it has to be uniform over time. It has to be permanent shock. If you anticipate that sanctions will be over, you'll figure out a way around import sanctions over time. Then you lose Lerner symmetry. If sanctions are pre-announced, you lose Lerner symmetry, right? Because you have time to prepare. If you have a lot of accumulated net foreign assets and foreign currency, you need to do something with that. Because uniform over time implies that you have to apply the sanctions also to the past trade surpluses, so to net foreign assets, right? And so the interesting questions really about thinking about the effectiveness of different types of trade sanctions is when Lerner symmetry breaks, right? In particular, the one really interesting one is when there is a lot of foreign currency debt, right? Because, and you cannot apply sanctions retrospectively, then you lose Lerner symmetry. And so the interesting questions that are left for like future research, I think, is like, can you use sanctions to trigger something like a financial crisis because of accumulated net foreign currency debt? Well, the story of Russia, there was not much net foreign currency debt. There were actually assets that were frozen, right? And so as a result, you know, there is like much less room. But what's important actually, if you know that you will go around import sanctions, doing import sanctions together with net foreign asset sanctions is a particularly bad mix, because that gives you incentives to wait until you will go around the import sanctions, right? Like it gives you intertemporal incentive to wait until import sanctions, you know, you figure out a way around it. So you don't want to consume today because you're willing to wait. And so if you don't want to consume today, the financial sanctions don't have a bite. Financial sanctions have a bite when you want to borrow today. But if you provide incentive to wait, they don't have a bite. So we kind of developed that idea a little bit in a PNP, but there is kind of a lot more room to think about, you know, what mix of sanctions is more effective when you're outside of Lerner symmetry. And so I want to get to financial repression, and that would be my, and then show you the simulation. So with financial repression, so imagine now you have this massive shock that people want to sell off Russian assets. That's exactly what happens in March 22, and want to buy anything in foreign currency, preferably outside Russia, right? And that's exactly what's happening. So what the government can do in response? Well, if the government has foreign reserves, so, and this is like a Friedman rule here. If the government has dollars and public really wants dollars, the Friedman rule says, well, give the public the dollars. That would smooth out that shock, right? And so that's kind of the principle that applies in these types of models with convenience yield. It's not about domestic currency, it's about government actually having foreign currency reserves. The public really wants it. If for whatever reason financial market cannot provide it, there is frictional intermediation or whatever, the first best thing for the government to do is use reserves. But of course, there were sanctions imposed on reserves, so that was not possible. I'm sorry, that was number two. Selling reserves would have been number two, and this is the first best, but it's not possible. So then there are two options for the government if it doesn't have reserves. Either be passive, and if the government is passive, what happens? Well, there would be this conflict between saving in dollars and using dollars to buy imports. And the way this conflict will be resolved, that basically exchange rate, ruble depreciates, dollar becomes much more expensive. It discourages both imports and saving, because you get in lower return now, and it discourages imports because imports are more expensive. And this rebalances the currency market, right? Because there is not enough dollars for both saving and imports. Again, because I assume segmentation, households cannot go directly to the US banks to get those dollars. They have to use the dollars that are available within Russia. And so because of the scarcity, you get this massive devaluation, right, of the ruble that rebalances the market, right? But what's the natural way for the government to respond to it? Well, the natural way is financial repression. How can you stop the savers want to have dollars? Well, you really make it a very bad way of saving going forward, because, you know, like you basically tax saving in dollars, and then there would be more dollars left for imports, right? So if you look at this earlier equation, you want to depress the desire to use dollars to bring money from today into tomorrow, and like you depress the interest rates that the households can get. This leaves more dollars in the currency market for imports. And that's exactly how this model works. What I was going to say here, the question is financial repression ever optimal? And so, I mean, Ivan talked about financial repression from a perspective of a representative agent, and there was a reason for that in his environment. In this environment, if you have a representative agent, you don't want to do financial repression from a welfare perspective. The representative agent is both a saver and a consumer, and you let the representative agent to decide what he would want to do with the marginal dollar, save or consume. But if you have heterogeneous agents, things change. It becomes a distributional conflict. And if you think that, you know, savers is a small fraction of people, like the wealthy people, versus the consumers who are more hand to mouth, the distributional conflict is you either accommodate savers, but then it would be very expensive to buy foreign goods for the consumers, or you put financial repression on savers, limit the depreciation of the currency, and then it leaves resources for the consumers. And then, of course, you can, you know, if you say that, you know, the savers are measure zero agents, then it's a no-brainer for the government to use financial repression. And so in this model, financial repression is really a redistributive tool. And it also stabilizes the exchange rate as a, you know, as a side effect, but from the perspective of welfare, it might be preferred. Okay, and so let me show you the model. the calibration, and I'm done. So I need two more minutes. So basically, you know, almost 2 years ago, so this is summer 22, we decided to calibrate things. And some things we already knew, and something we didn't know. So what we knew was the freeze on net foreign assets. So we could put in the model exactly the size of the freeze of net foreign assets. That was easy, $300 billion. We already were seeing that imports are mean reverting. So basically, let me show you the picture. So you see the imports as the blue line, and you know, it's remarkable how fast they mean reverted. So by the end of 22, they fully mean reverted. So whatever import sanctions were in place that, you know, European countries were very proud of, it took about 4 months to figure out ways around those sanctions, right? You know, like trade of Russia with, you know, Kazakhstan, Uzbekistan, Armenia, like quadrupled, right? So basically all the European goods started going through these other countries, and you had effectively, you know, very steep import sanctions in the first 4 months that mean reverted. And of course, China became the biggest trade partner and so on. And, you know, there were no export sanctions effectively. Russia was selling oil at very high oil prices without any sanctions until the end of the year. And so sort of we knew that, and so what we put in the model was that import sanctions will mean revert by the end of the year. Exports are very high in the beginning because oil prices are high, but gradually Russia will lose export markets in oil. That's what we assumed, that like sanctions will come in place effectively, right? And so, and yeah, like when we were doing it, it looked like the cap was potentially working, right? Like it looked like people were talking about the cap, that just the talk of the cap was creating the discounts in that market. So it seemed like, you know, like it would work, right? And so we got this prediction. So this is the decomposition into shocks. And this is kind of interesting. So first of all, what you see is that net foreign assets, that's a permanent thing, but you smooth it out over time. So basically it has like a permanent pressure, but this is like 3-4% a year in perpetuity, but it just doesn't have a big pressure. What really has a big pressure is this capital outflow when the government cannot accommodate it with reserves, and that's the blue shocks. So what really moved the exchange rate a lot is the capital outflow, which like typically Russian government would accommodate it with selling reserves, but it couldn't because of sanctions. And that really what triggered it. And that was the moment where you can kind of think about the possibility of a financial crisis. If there was a lot of dollar debt in the economy, which there was not, that was the moment when it could have, you know, it could have led to a full financial panic and meltdown. But it didn't happen. And so what happens like immediately a month later, so this is monthly data, a month later the trade thing kicks in. So it's both that imports are low, so you don't need currency to buy imports, and exports are high. That's the orange and yellow. And that's a force that leads to appreciation, right? And that force persists for about a year, and then over time imports recover, and then we were thinking that the export sanctions will kick in, and that's the yellow bars on top, which lead to like this. In the end, what happened is that exports did not decrease, but a big chunk of exports never coming back to the country, so it's like a continued capital outflow, so a big chunk of exports never returns. So the yellow is not that the exports are low, it's that the, you know, the currency revenues from exports are not coming back to the country. And so we made these 2 mistakes by not putting those 2 shocks, but they sort of like, in the end of the day, that explains why we, I guess, get it right. Okay, I'm gonna stop here because I'm out of time. The last thing I was gonna say here, you know, how do we think about, how do we think about whether sanctions are working or not? Well, the sanctions that are in place do exactly what the sanctions are intended to do, right? They don't solve all your problems, but they're clearly working. They work through market mechanisms, but the government has pretty effective response to a lot of them. And so you really have to think about it at the overlap of what the sanctions do and the government response does. And at the end of the day, the sufficient statistic is the fiscal space that's left to the Russian government. And so by the result of all the sanctions that were imposed, they had a fairly limited effect on the fiscal space for Russian government. And I think that's the sort of the sufficient statistic. And so if you evaluate the sanctions, like, you know, it basically had a modest effect, because truly, if you think about the sanctions, the ones that were in place are modest sanctions. Right? Russian oil revenues were never cut down. Russian oil revenues are still quite a bit above what they were before 2001, right? And so that's why, you know, when people say sanctions are not working, well, you know, I think that, whatever, yeah. Let me stop here.
Yeah, sorry, I messed up. Okay, got you. Thank you, yes. Okay, so first I'd like to thank Stephanie, Vivian, and Pablo for inviting me to this such a awesome conference, and happy birthday to Martin.
I may not know Martin personally, but I have learned so much from his work over years. And in addition, like many of you, I have been using Stephanie and Martin's textbook on open macroeconomics for both of my undergraduate and graduate teaching. So I think I'd like to say a huge thank you to Stephanie and Martin for your hard work and for your contribution to our field. Great, perfect timing, yes. So let me go back to the Oleg's work. Let me see. Okay. I have to watch here. I have to, yes, okay. So the motivating question is, what is the impact of sanctions on Russian economy and its government policies? Okay. I want to say this is, and also in general, this matters for the sustainability of the war. Okay? And this is actually a very hard question to answer, given that we don't have much of data available, especially after 2022, you don't see the national account data from Russia. Okay? So what Oleg and Dima, they have designed a very smart methodology to figure out. So what they do is they build a model of exchange rate that follow their previous work, and they extend the model with these sanctions. And they provide a very comprehensive analysis of this impact of external sanctions on exchange rates under different scenarios of government policies. And then they back out this persistent impact of sanctions using the trade data, and the model match pretty well the exchange rate dynamics. It first appreciates, and then it first depreciates, and then appreciates, and then medium term has another depreciation. Okay? And then they can use the model, the back out shocks, to quantify the implications of sanction on Russia's fiscal deficit. And you can also consider all alternative policies. I'm going to echo what Linda said here. Oleg's work is very clear, so not much of, I don't have to say much about the model mechanisms. Okay? So my discussion will mainly focus on what we see in the data and the related literatures. Okay? So let me just remind you the key or the core of the model. Okay? I'm going to focus on this private equilibrium. Over here, what is exogenous to the economy is the endowment, the tradable endowment and non-tradable endowment, and the import prices, because this is a small p economy, and also the foreign interest rate, the R star. And the private agents also take as given the government policies. Here, oh, I'm gonna go back 1 second. I guess, yes, okay. So, exactly, don't look at here, yes. So what the government, the government's policy has this net foreign reserve or the foreign exchange management, the difference between the reserve holding of the government and also the private demand for the foreign currency, the F minus B. And also the non-tradable prices being controlled by the country's monetary policy. Okay? And they can also do financial repression so that the interest rate of private agents facing for their foreign currency holding can be different from the foreign interest rate. Okay? Take those as given. Well, the private equilibrium has 3 components. What is the consumption of imported goods? What is the foreign currency holding of private agents? And the equilibrium, what is the exchange rate of the economy? Okay? And they basically satisfy 3 equations. The first one is the balance payment condition. So the left-hand side is, the right-hand side is the net export. Your export, Y star, minus your imported goods, that will go into the foreign currency holdings of the government. The second one is the domestic order equation for foreign currency holdings. Okay? And that's just a standard, but it has 2 things different. First is this V prime, which is captures the marginal benefit of household, actual marginal benefit of household by taking this foreign currency holdings. And then because of this financial repression, so the interest rate, the private agent holding can be different from the foreign rate. And then the last one, the exchange rate basically will make sure that import demand is being satisfied. So the left-hand side is the marginal rate substitution between foreign goods and domestic goods, and right-hand side just the relative prices. Okay? So it's easy. If you have equation 1 and 2, that gives you the BT plus 1 and CFT, and the last one will give you the exchange rate. Okay? I do have a easy version than this is, suppose the government just choose the foreign currency, foreign reserves. Instead to choose the net one, let's just make it a government choose foreign reserve. In this case, the whole thing become very static. We basically can use the balance of payment condition to solve for the imported goods, okay, or the foreign consumption. Because once you know the government policy, you know the exogenous endowment, you know what is the CF. And then you can use the last one, the import demand, to back out what's the exchange rate. The older equation, we don't have to care about it, because whatever the government want to the private agent to hold, he can choose this financial repression or this RH star to make sure that one hold. So I think this is an easy version. I don't know why they choose the other one, because the other one you need to know the dynamics. Okay, okay. So given this is the case, we can easily solve the consumption and also the exchange rate. Okay, and then now here we can talk about how the sanction matters for the exchange rate and for imported goods, right? So there could be trade frictions, trade restrictions, that could be financial restrictions. And in general, we can easily to see that the export sanctions, that makes the YT star fall, that will make the exchange rate to depreciate. Import sanctions will make the exchange rate to appreciate. And there could be a fall in domestic output just because of multinational firm may go out. And so that will make the exchange rate to appreciate. And then a reduction in the foreign assets that could make the exchange rate to depreciate. And the last one is, if suppose there's an increase in the foreign interest rate, that can mimic this limited access to safe assets, will also make exchange rate to appreciate. Okay? But all the sanctions will drive down the imports. And so as we said, then how are we gonna back out how the impact of sanctions on the economy? It depends on the persistence of the shocks, okay? Not much data to use, so what all academia use is to use the trade data. So in particular, this is their calibration. Here we go. Okay, so they use the sanction data, and also they try to match this import data to try to use the import data to figure out what is the persistence of the shock, okay? And then they have to make assumption over what is the government policy over here. So they just assume that the government is gonna make sure that F equal to B, okay? And then I wanna say that there's some still freedom to choosing the persistence, because you only match one imports data, that seems to be not enough to pin down all the half-lives or the persistence of the shocks. Okay? And then the model match pretty well the observed exchange rate dynamics, which is the left-hand side. Okay? And then OLEG shows us the decomposition. So the key takeaway from here is the main source of exchange rate dynamics is driven by the financial shock. That you can see the early period, the blue bar was very high. That drives this depreciation of the exchange rate. And then the later period is mainly by this yellow bar, which is the export sanction. Okay? So the long run exchange rate will depreciate, but that's mainly because future there's a reduction in the export due to the export sanction. Okay? So that's one of I want to see the key takeaway of the quantitative part. And then, of course, using the shock, they can talk about fiscal revenues and also alternative policies. So my first comments over the paper is about this empirical impacts of sanctions. Okay? I want to say that is 2022, we don't have a lot of data, but then we could go back to see the 2014 sanctions, trying to see a little bit of validation of the model. Okay? There, we're gonna have more aggregate data available, not like in 2022, only we see mainly the exchange rate and the trade data, okay? And there is also this historical data on sanctions that will have document all the sanctions in the past. We could also use the cross-country over time data to sort of like validate the model, okay? So let me show you the 2014 data. To the left-hand side is the, after 2014 sanctions, what's the exchange rate look like? in Russia. Okay, so here the vertical line is the sanction dates imposed by the U.S. in March, July, and September in 2014, and the right-hand side is the 2022 sanction. Okay, and you can see that at the beginning, the left picture will show that is right out around the sanctions, exchange rate actually doesn't move much in 2014, and it's only later it starts to depreciate. Okay? And that's in 2022, we see similar long run pattern, there's a depreciation. I mean, but then of course in 2022, there's a sharp depreciation and then there's a appreciation. So there's overshooting over here. Okay? So what is some difference? I mean, many things that can be different, right? But one major difference, I think, is the oil prices. So here, now I'm putting oil prices. I apologize for the colors. Now the blue line is the oil prices. The right line is the exchange rate. Okay? And you see that is the similar thing. When the sanction imposed in 2014, exchange rate doesn't move much. The oil prices also doesn't move much. And then when the oil prices start to fall, exchange rates start to depreciate. And this period of time that this declining in oil prices is not because of the international sanctions. Okay? It's also not because of the pressure from the US to the oil producers. So that's totally uncorrelated. Okay? And then the 2022 sanction is similar thing is we see this appreciation part actually happens at the same time when the oil prices is actually pretty high. And later when oil prices falls, exchange rates start to depreciate. So I do have one question is whether the exchange rate is driven by the trade restrictions, by sanctions, or actually really driven by the oil prices. Because if it's oil prices, it's probably not because of trade sanctions. I mean, the literature also found out that is using historical sanction data, they found that is sanction doesn't play much role in terms of trade. Okay. Okay, so another interesting picture is the sovereign spreads. So now the blue line is the emerging MB spreads of Russia. Okay? The reason I plot here is because this is another price which captures all the news or information or expectations about the Russian economy. So that's also captures, yeah, that's why I said that, yes, okay? And you see that the two series are highly correlated in both 2014 sanctions and in 2022 sanctions, okay? The correlations are both around 70%, okay? So this is actually consistent or related to the twin Ds, which been documented by Uribi's work with Stephanie and Vivian and also Shang Hong. Okay? So of course, what they show is that during default, there is also depreciation. Okay? And what Christina and we find with Gabriel, we found using many emerging markets case, this is also the case that the spread and the exchange rate are highly correlated. So depreciation means a high spread. Whereas, of course, in the Russia case here, Russia has a loss of Federal Reserve, and also it's a net creditor in this case. But that doesn't mean that the sovereign spread, I want to say the sovereign spread may also capture some information about future news expectations or future potentially default. Okay. 3, okay. Okay, and then so I also plotted this GDP and investment over here after 2014. This is from 2010 until recent period. And you do see that, so now the blue line is GDP, the first picture, and then the second picture is investment. So there seems to be long run impact of war or sanction over GDP and investment, okay? So again, that could be many things happening, but then what we see that is, I want to say this is a long run change in terms of GDP and investment may also have a long run impact over exchange rate. By saying that, I want to call your attention for two recent work by our fifth-year graduate students, Marcos Mullen. So he has 2 works. The first one with Su Kiao Wu is, what they show that is, first thing they show is, in the short run, the exchange rate a lot is driven by financial shock, and the long run is driven by the trade frictions. So that's consistent with Oleg's and Dima's finding over here. Another thing what they show that is investment is a very important channel. Okay? And another work he has, Marcos has is his joint market paper. He showed that is actually using, if you consider U.S. interest rate, a very important driver is the U.S. military expenses. When there's an increase in the U.S. military expense, we see a lower investment and a higher net trade flows, and also a depreciation of U.S. Real exchange rate. So I think that is incorporating the government expenditure and the investment into the model will be very important. Of course, in this case, when we consider the sanction event is a very short term, and so the investment may not play roles, but in the long run, it seems like the military or the wars could have very important implications over the exchange rate. Okay. You have 1 minute, 2 minutes. Okay. So the last one I think I want to say is about optimal policies. So here, all I can actually experience are lots of different scenarios in terms of the government policies. It will be interesting to study the optimal policies over reserves and monetary policies and financial repressions in response to this various sanctions. The data we observe is probably already, I don't know how we interpret it, but if you think as under the optimal policies, that's already incorporated the policies. Okay? And another thing is if the government anticipates the future sanctions, they may already adjust their optimal policies ex ante before the happens in wars. Okay? And then we have, I guess we have lots of people who are working on the optimal policies and include All Access' own work. Okay? So I think that's it. I want to say it's a very nice paper. It provides a framework and comprehensive analysis over the impact of sanctions on exchange rate. And we can use that to evaluate the implied fiscal revenues after sanctions and alternative policies. It definitely makes a tremendous contribution to the field. That's it. Thank you.
So let me ask a question as well, which is, when you talk about financial sanctions here, it's on foreign exchange reserves and limiting access to safe assets. In this case, other tools for financial sanctions were restricting access to insurance markets and also restricting access to the financial payments communications infrastructure through SWIFT. So I guess I would just add a question for you here, which is when you think about those kind of infrastructure types of financial sanctions, where does that come into play? Is it something about increasing the costs of trade as well as other financial transactions? Or to tie into your calibration, is this something that increases the persistence of the real side sanctions? So just to add that to these comments.
No, this is super interesting. And thanks so much for this question, Jan, for a great discussion. Let me take a few minutes just well, one thing I wanted to connect to Stephanie and Martin's work on export controls. Russia imposed export controls, and unlike in Latin America, it just worked beautifully over the last year, right? And so this is a situation where you wish that Russia was just like other emerging markets, messing up macro and not starting wars. But when you don't mess up macro, you can make those things like export controls work well. It clearly extends the period along which they can finance the war, right? And so this is this is a separate question. I fully agree that the story of oil prices is the key story, right? In the end of the day, oil prices is the export revenues. And so the fact that oil prices came down for completely exogenous reasons in 2015, that was the main effect then, right? On everything, including investment. And the fact that oil prices are high now, that creates a completely different story. And this is an important point made by others, but when Russia mess ups the world, it has a positive feedback loop through high oil prices. So there is an incentive to do some crazy stuff. It leads to high oil prices. That's like a positive feedback loop. And the obvious response to that is to keep oil prices low. And US has the capacity to do it. That would be by far the most effective sanctions, more effective than anything else. But what's super interesting is that what we've learned is that the sanctions that prove to be quite effective are the payment system sanctions. Like the stuff with the oil price cap, insurance markets, when oil prices are at 90, none of that works, right? Like there is so much surplus from selling that oil that it just doesn't work. If oil prices are, 65, then a price cap would have been much more effective. But when they're 90, it's just not effective. And the insurance doesn't work because there is the shadow fleet and so on. But what proved to be effective are the payment system sanctions. And this is missing in the model. And this is, I think, a very interesting step to go forward, is to understand why having like rupees and yuan, which Russian government has a lot, is not a substitute even in the spot market for having dollars. Like Chinese exporters and India, well, Russia doesn't buy quite as much from India, but Chinese exporters want dollars. They don't want neither yuan nor rupees. And so the payment system sanctions are clearly playing a role. And so the way I think about it, in the limit, you get to a barter economy. Like Soviet Union was a barter economy where all transactions came through Finland. So you export oil through Finland and you buy goods through Finland. And that's like kind of the limit of what financial sanctions can do. So what the payment system do, they actually make it much harder to sell oil to India and then buy goods from other countries, right? Like you need to go across payment systems. And we don't have it in our models at all. And we don't have it in this model as well. But that proved to be a very interesting actually thing. But in the end of the day, I think it's the financial sanction that pushes you closer to like this financial autarky and like a barter trade. And that's kind of interesting. And the last thing I was going to say, like the way you solve the model, this is great because it shows how you can make the households hand to mouse, in the sense that whatever government gives them to buy imports, that's what they do, right? They don't have really their own intertemporal decisions when they're segmented from the international financial market. So this is one way to solve it, to say you're hand to mouth, and then the prices just adjust. Both the interest rate in the domestic market and the exchange rate adjust to make households happy with their decision. And that's like the two equations that you showed. We wanted to like do it a little more generally to show that Lerner symmetry applies. And so all sanctions, a sufficient statistic for them is how it affects the terms of trade, even letting the households do the intertemporal decision. So yeah, so let me stop here, but super interesting.
Questions?
Let me just give it to you for the recording.
Hey, Alex, so it's a super cool paper. But can you expand a little bit more on the discussion of whether you could use, maybe just the data in this case is kind of, for obvious reasons, sort of hard to get, but is it possible to use kind of this experience to think about some sort of elasticity or substitution between kind of, on the sort of transaction side of different currencies? Or maybe it's just totally out of the question given the, maybe you have prices and quantity, anyway. So.
No, we don't have, I mean, we have a lot of anecdotal accounts how basically it's difficult. So Russia has accumulated the rupees and yuan in significant quantities from selling oil. And we have anecdotal evidence that they have hard time doing both FX interventions with those currencies. So that's about the elasticity in the currency market. But what's even more surprising, they have hard time paying for imports. And that's about spot market. There is no kind of intertemporal thing involved. It's just that having a rupee is not the same as having a dollar, because you don't have access to the spot currency market because you need to cross the payment systems. And I have neither a model for that nor like good data apart from the anecdotal evidence, but I think that's what's clearly missing. And that's been much more effective than, for example, oil price cap, like from my subjective evaluation of this. Yeah.
Other questions? Okay, well, thank you very much, and we'll have a break until 11:30.
Thanks a lot. So now I actually understand.
So would you like to have a seat? Excuse me, the session will start soon. I would like to thank Vivian, Pablo, and Stephanie for having me here. I'm Yoon Jo from Texas A&M. If you don't know me, I grew up from a very rural area of Korea. My parents never been abroad, and I'm first generation college educated person in my family. So actually coming to Columbia to get a PhD was a unknown territory. It was very intimidating thing for me. So I really remember very well when I had a first meeting with Martin about my research idea. At the time, I wasn't able to articulate what I wanted to do. I just kept saying, but I had no idea what I wanted to study, right? But Martin was very patient and kind. He waited until I finished talking, and then he started to give me a comment for the idea that I had no idea. So he was very helpful and warm and kind to sharpen my idea. I'm extremely indebted to Martin and Stephanie for my PhD dissertation and get a job. So I was in the dinner yesterday, and then all the speech remind me again that this wide variety of group of people from academia and central bank somewhat reflects his nice quality and also his big contribution to emerging economies and macroeconomics topic. So I'm very proud to be part of this family, and happy birthday again, Martin. And then Linda will give a talk about labor mobility in currency union. Thanks.
So I'm very happy to be here. You know, when you're asked to come participate for a birthday celebration for someone like Martin, what can you say but no? Or I mean, yes. And then you say yes, and then you look at the program and you think, oh my, what have I got myself into? What an impressive crowd here. It's really quite amazing, and I'm quite thrilled to be a part of this. So I'm going to talk about something that is not about emerging markets, but it does, I think, pay tribute to Martin and Stephanie's work in a couple of dimensions. One is that the model, you'll see, relies very heavily on their work, so that will become familiar in a moment. I also want to say the paper is joint. I don't know if the slide is going to come up here. Do I do it? Okay. Well, the paper is joint with a current student, Aaron Gibson, and a former student, Christian Probsting. So in that sense, I think it pays kind of to your legacy of working closely with students. I will say, though, all of the comments during dinner last night and all of the time you spend with students, I was starting to feel very guilty about my email inbox and how many students I owe comments on their papers and how many meetings I have in store for me over the next few weeks. So it's a tall standard to live up to, but it's a wonderful one. So thank you for all of that. So the slides are still in progress. So this is going to be a paper about labor mobility in a currency area. So the thing we wanted to understand is, can we explain unemployment dynamics? Our focus is going to be on the euro area. And we wanted to think about not just, there we go, with a little bit of a lag. It's here. There it is. Okay, so Aaron Gibson, oops, don't touch. So Erin Gibson is a current student, and Christian Prubsting is a former student. And this is a paper about the level of unemployment. So we've written previously about the volatility of unemployment and the dispersion of unemployment across the euro area. Now we want to ask, can we get some understanding of what drives the level of unemployment and how that might be affected by labor mobility? There we go. Okay, so just to kind of show you a picture, one you've probably seen in various ways. The blue lines are showing you unemployment in the euro area and the European Union. Not surprisingly, they're very highly correlated. The red line is the unemployment rate in the United States. And you can see, if we exclude that last shaded area, which I'll get to in a second, you see that unemployment generally in the United States is both lower, and you'll see in a minute, it's also less volatile, all things considered, than it is in the euro area. Now, I'm taking out the COVID era in the US data for the reason that during that COVID period, fiscal policy in the euro area tended to support keeping firms connected with their employees. So the subsidy went to the firm and it passed through to the worker, but the intention was to keep those worker-employer connections intact. In the United States, rather, the idea was, well, firms are going to lay off their workers and we want to provide generous unemployment as well as try to support firms, but severing those ties was fine, according, the way these policies work. So that would be an interesting thing for future work, but we don't want to talk about that today. So for the purposes of today, we're going to take out that big spike in US unemployment there in the red line. So, as I mentioned, in previous work, we focused on the dispersion of unemployment rates across the euro area, and we asked kind of a Mundelian question: to what extent could increased labor mobility offset the fact that euro area countries have given up a flexible exchange rate, which would help them accommodate shocks? This current paper, we want to ask, can we help think not just about the dispersion in unemployment, but the level of unemployment? And is it possible that labor mobility could also help lower average unemployment rates across the euro area? So how does labor mobility affect the mean and the dynamics of unemployment? This is lots of suspense here. There we go. Oops, and then I have to go back. Can I click here though? Oh, okay. So we're going to deploy a plucking model of unemployment. So this is an idea that goes back to Milton Friedman, who said, we can think of there being a helium balloon. Think of kind of a deflated one from the birthday party last night. It has to be a little bit deflated because it's going to move kind of slowly. But a recession comes along and it tugs that balloon away from the ceiling. And that's the sharp recession. And then you get a gradual recovery as that balloon pops its way back up to full employment. So this was an idea that was also used in Dupraz, Nakamura, and Steinson in looking at US unemployment rates, and we kind of want to extend this and think about this in the European context. So why does this plucking model help us explain data? Well, downturns, we're going to see in the data, tend to be quick, and the recoveries are longer and more gradual. We also see that downturns tend to predict the size of the recovery. So however deep the recession is, of course, unemployment works its way back up to full employment. So those things are correlated, but it doesn't tell you much about the next recession. So the current recession doesn't tell you about how deep the next recession is going to be. The other thing about this model is that temporary shocks, in other words, this pulling the balloon down, affect the level of unemployment, as well as the variation in unemployment. So that's the model we want to deploy here. So here's where Schmidt-Grohe and Uribe come in. We're going to be having some downward nominal wage rigidity in the model, and that's going to help us deliver some unemployment. And it's also going to generate some asymmetric responses to shocks. So positive and negative shocks are going to do different things in this model, which are going to help us get that asymmetry during recessions and recoveries. We're going to model this as a small open economy. So I want to say this is a very stylized, simple little model with just a few ingredients in it, and it's going to deliver some implications. Work yet to be done is going to be, we're not going to hit the calibration just right, so there's more to do to add to the framework. But this is a very simple model. There's going to be trade, and we're going to allow countries to have access to capital markets. There's also going to be a migration decision. So we've got a dynamic discrete choice problem where workers are going to be thinking about, I'm in my country, but I'm thinking about what the expectation is for payoffs in terms of my utility if I move, in terms of am I going to be employed and am I going to get consumption if I migrate abroad. And so that is going to be the new piece that we embed in this model. And we're going to see to what extent is this a partial substitute for flexible exchange rates, or if you want to think about it, flexible wages. Okay, so first let me walk you through some data. So I already showed you the aggregate Euro area and US unemployment rates. Here's just a selection of countries, and we follow this Dupraz et al. Method for identifying peaks and troughs in these series to identify when the recession hits and when the recovery ends. And so you can see that that's what these dotted and dark lines are. They're all according to the same scale. So you can see some countries have quite high unemployment rates and other countries have less high unemployment rates. You also see that their business cycles are not fully correlated. If we do this for the United States, you'd see much more coherence in terms of unemployment rates across US states, and you see less so in the Euro area context. So here's some basic statistics. We don't have this huge screen like we did yesterday, so the numbers are a little bit small, so I apologize if they're hard to read. But I just want to highlight a few things. So column 1 and column 3 are the aggregate data, which we often look at. What I want to focus on here, though, is I want to focus on columns 2 and 4, which are going to be the average state. So this is the contiguous US states. We've got Alaska and Hawaii left out because migration is a little bit different between those states. And then we've got the average Euro area country, okay? And the thing first I want to focus on, and colors don't come through very well, but what I want to highlight are the red numbers there at the top, which are the average unemployment rate for a state or for a country, and the standard deviation of unemployment and for a state and for a country. And what you see is that the average unemployment rate for a typical US state is considerably lower than for a typical Euro area country. You also see that the standard deviation of unemployment is higher in a Euro area country relative to the United States. I also want to, and I mentioned already that when we look at the correlation, that the raw correlation across countries is lower than the correlation across US states. We also see, now this is some of these asymmetries that I was mentioning that motivate the Plucking model. We see that the speed of expansions tends to be faster, the speed of contractions tends to exceed the speed of expansions. In other words, pulling the balloon down goes fast and the recovery comes up slower, and you see the duration of expansions is longer. It takes unemployment longer to work its way up than it does to get spiked down. And down at the bottom, we've got these regressions that are again, the expansion. If we regress the expansion on the preceding contraction, that tends to have a high correlation, a high coefficient. And if we again do the contraction on the preceding expansion, it's much lower. In fact, it's not statistically significant. This is just depicting this with data, so I'm going to repeat this when we get to the simulations. What this is showing you here is the relationship between the standard deviation of unemployment and the average unemployment rate. So what you can see is that states or countries with highly volatile unemployment also have higher mean unemployment, and if they have less volatile unemployment, they also have a lower mean unemployment. Interestingly, so the red are US states and the blue are European countries. And a couple of things to note. One is that the relationship, the slope, looks to be very similar. We can't reject that the slope of those two lines isn't the same. So that relationship looks very similar. But the other thing that you notice is US states tend to be pulled closer to the origin with both lower mean as well as a lower standard deviation of unemployment. And this is something we want to check in a model. Can we replicate that finding? The other thing I'm going to talk about, we're going to have net migration in the model. People are going to be able to move. So this is something that came out of some previous work with these co-authors, where we were asking, is it the case that when unemployment is high, and this is unemployment after taking out state and time fixed effects, do people tend to move out of that state or that country? And when unemployment is low, do people tend to come into that state or into that country? And on the left, you see the data for all of the bilateral pairs in the United States. And what you tend to see is that there's a negative relationship, statistically significant, that suggests for about an increase in 100 people that become unemployed, about 35 people leave. So that's pretty significant. That is about a third as high in Europe. In other words, there's about a third as much responsiveness to unemployment differentials in the Euro area relative to how much labor mobility there is in the United States in response to business. This is at the cyclical frequency to unemployment fluctuations. So this is something we're going to want to build into our model and calibrate to this data. And this is just showing you that if we do an impulse response function with data, this is significant. We actually see significant population movements. That's the green bars at the bottom are for the United States. The Euro area is on the right. Over time, it doesn't happen right away. It takes a while for people to move. But when they do move, it has a significant impact on population. So this is an important mechanism, we believe. Okay, so just to summarize, higher mean and standard deviation of unemployment in the Euro area relative to the United States. We see a positive association between high mean unemployment and more variable unemployment. We see sharp recessions, longer expansions, and we document that there's less mobility in the Euro area than the United States. So these are the facts we want to build in. All right, let's get to the model. As I said, we're going to have this plucking model. We're going to have a small country with a fixed exchange rate. There's going to be some labor migration built into the model. We're going to have downward wage rigidity that's going to give rise to unemployment. Trade is going to be an Armington trade structure. And in this version of the model, we're just going to have TFP shocks. We're working on demand side shocks, but for now, I'm going to focus on TFP shocks. We're going to have two kinds of people in this economy. We're going to have capital owners. These capital owners are going to be immobile. Now, this is going to help us. It's a simplifying assumption, but then we don't have to track wealth as they move around. So these guys are stuck, but they have the benefit that they can trade in international bonds, and therefore they can smooth their consumption. Then we have these other workers, these other guys in the economy, and these guys are mobile, but they're hand to mouth, and they don't own capital. So they earn their wages, they supply labor inelastically, they're going to experience some shock that's going to deliver some demand for their labor, and they're going to supply that demand for their labor. And they also have the ability to look around and ask whether opportunities are greater elsewhere. So we've got this worker, go into this problem a little bit, or this feature of the model a little bit more, who's currently living in country I, and he can choose his location looking forward. So he's looking forward and he's saying, well, what would be my utility in I relative to being in country J? He's hit with some locational shocks, okay, that move things around. This tau is going to be a variable that a parameter, it's the cost. It's going to be some barrier to moving, and we can set that cost to match average migration rates between Euro area or between US states, depending upon the context. And then he's looking forward and saying, are these shocks persistent? What are going to be my payoffs going forward? And so the shocks here we're going to assume are IID, these epsilon shocks, and they're distributed according to this type 1 extreme value. This is a technique or an assumption commonly made in this labor mobility literature, and that allows us then to characterize population and whether people move or go. So then we can track this NTW, which is our population. We have to take into account the people that come in and the people that go, and those two things depend on the relative shocks at home and abroad. The way we're thinking about it in this simple model is that the rest of the world, we're going to make this country really small, and they're going to be taking prices and the outside option as given. So here it's much simpler than doing a multi-country thing. They're really just asking relative to, I know what's happening to me here, and then I look and there's always this fixed outside option. Would I do better there, or am I better? And those guys in that country are thinking, well, maybe we should come into this small open economy because things are better in the small open economy. Okay, so we've got competitive firms that hire capital and labor, nothing complicated here. And there are these TFP Z shocks. They face this downwardly rigid wage, which means, we've got this slackness condition where either the wage has adjusted, in which case we have full employment, or we are hitting that boundary, and then we have some unemployment. We don't fully supply. This LS is not going to be equal to L, and we don't have full employment. We've got final goods producers that combine home and foreign inputs. So there's going to be a local good that's going to be put together using inputs from our own economy, and then all of the goods that we import. And that's a standard CES thing. Okay, so we've got demand for the imported intermediate good, as I've just mentioned, and we've got foreign demand for our domestic intermediate. And you can see that E in these two equations is the exchange rate. We're going to set that equal to 1, but we can consider a counterfactual where the government could move the exchange rate around in order to eliminate unemployment. So that's going to be one of the experiments that we can consider. Okay, calibration of the model. Nothing terribly complicated here. And again, this is a really simple model, so we're doing things it's a pretty sparse parameterization here. Okay, we have to do we've got a lot of nonlinearities here because we can hit this binding wage constraint, and we've got this migration decision. So what we do is we solve this using a global solution method. We've got at this point just one exogenous state variable, and we have 3 endogenous states, and we do this fixed point iteration on the Euler equation. And it's a simple little model, but it's a tricky little model. Okay, so here are some basic results. So in the first column, I'm showing you the data. So you can, and I'm being very transparent about what we do well and what we don't do well. And so we've got here the average, some migration and unemployment statistics, some business cycle moments in the second block, and then at the bottom we have these kind of picking up these asymmetries in expansions and contractions. So how do we do? So first we start with relatively low labor mobility. And you can see we kind of understate the average level of unemployment and overstate a bit the standard deviation of unemployment. So we don't quite get the wedge that one might really like to have between the mean of unemployment and the standard deviation. That said, we don't have a natural rate of unemployment in this model. So all of the unemployment is driven by this sticky wage phenomenon. We don't have search and matching frictions or something else that would drive up kind of the long run mean unemployment rate. Standard deviation of migration is pretty similar to the data. We get that migration and unemployment are related in a way that show up in the data. Our business cycle moments aren't terrible. The one that is terrible, of course, is the correlation of net exports and GDP, but that's because we're only trading goods. So we always get this in a model where, business cycle model, where we don't have investment. If we had investment in the model, we could flip that correlation. Plucking statistics, we do get expansions lasting longer than contractions, and we do get this phenomenon that the expansions depend on the previous contraction and not vice versa. So that seems to be working. The second column is showing, or the third column of data, second column of simulation results, is saying, what if in the euro area we had the amount of labor mobility, roughly that we see across US states? So we're adjusting that gamma parameter to see if we have the ability to move around more, do we get, does it help? Does it help reduce mean unemployment, and does it reduce the volatility of unemployment? And indeed, it does work in that direction. You can see average unemployment comes down. And I do want to say, in a typical business cycle model, we don't have much to say about the average level of unemployment. We typically look at deviations around the mean. So there's a success here in that we're impacting the average level of unemployment. And we're also bringing down the standard deviation of unemployment. Obviously, migration now is more responsive to, is that time? No. What is time, by the way? 7 minutes. Okay, I'm going to hurry up. Okay, so the model is working in the direction you might expect. We add labor mobility, and we're able to bring down the mean level of unemployment as well as the standard deviation. The model is also working in the sense that we're getting these asymmetries. So here, if you, the blue, this is just how these models with wage rigidities work. So if we first look at the solid lines, these are with low labor mobility. You see that when you get a positive shock, the wage rises, unemployment falls a bit, and we get some people moving. And if we have a bad shock, we get much more unemployment because the wage can't adjust very much. The dotted lines are showing you what labor mobility does. And so it mitigates these effects. It makes the bad shocks less bad, and it does kind of also dampen a little bit the good shocks. Okay, so another experiment we can run, we kind of have a horse race here. There's sort of two mechanisms that are working on unemployment. One is wage rigidity, and the other is labor mobility. So this table is kind of helping see to what extent is labor mobility doing the work to bring down unemployment and reduce the standard deviation of unemployment, and to what extent would an adjustment in wage rigidity help us in that dimension. So these two things are kind of complements to each other, and they're both working in the direction of explaining the higher level of labor. They're complements. They're doing the same thing. They're both reducing the standard deviation and the mean of unemployment. This is, I promised you that, you can think about those dots here. What we've done is, it's a little hard to see, the colors are not great up here, but what this is supposed to show you is that as we increase labor mobility, the dots are getting pulled more toward the origin, just as we saw in the data, and it doesn't change the slope. It's just pulling both the mean and the standard deviation down in proportion. And the one on the right is showing that for a given standard deviation of TFP, labor mobility reduces the mean level of unemployment. Again, what we would have predicted. Okay, last thing we're going to do before I close. Because we have an exact solution for consumption and for mobility, because we're using this, we're doing this global solution method, we could talk about welfare and just directly calculate welfare out of the simulated data. And so what we see is that if the government could use the exchange rate to get us back to full employment, it's a perfectly wonderful government that can manipulate the exchange rate exactly to get us to full employment, we get pretty sizable gains from that policy. So it's 5% of permanent consumption, even in the low mobility world, and this tells you how much labor mobility does. So we have this perfect government that, again, reduces unemployment, but we can see that government would have less work to do if it was an economy that had more labor mobility in it. And then finally, we can ask the question, within the currency union, how much benefit do we get from having more mobile labor? And in this model, it suggests it's about 1% of permanent consumption, so pretty sizable. Okay, so just to conclude, we think this plucking model is probably a direction to go to think about how to think about unemployment dynamics across countries. The model generates some, although not enough, asymmetry in the business cycle. Increased labor mobility works in the direction that we hoped it would, that it reduces both the mean and the standard deviation of unemployment. Future work, better calibration, better quantification. We have these two parameters, neither of which are ideal levers to if I had to tell a European policymaker, what should we do? What are you saying? Both of them are kind of structural in a way. One is how do we make people more willing to move, which probably involves some institutional features. And the other is how do we reduce wage rigidity, which also has some structural features to it. So they're both kind of embedded in the economy, and it would be good to have a better understanding of which of those frictions in the model or in the real world would be an easier tool to work with. We also would like to add demand shocks to the model, and we think the whole thing is going to work better when we have more persistent shocks. So I will stop there.
Great. Well, before the slides, thank you so much, Vivian and Pablo, for including me in the program. It's a great conference, really excellent papers, really fun. And happy birthday to Martin. This is, I mean, Martin and I, unfortunately, are kind of the same age, so we've been together. So I've been knowing for a very long time, and I would say two things about him. One is, it's the macroeconomic of emerging markets, but Martin and Stephanie's work has been much broader than that. And you know, this is an example of downward rigidity, which I think has been extremely influential in macro. It helped us a lot of us thinking about, you know, business cycles. And there's Jess here, the work with Jess on liquidity trap, equally influential in a lot of my work. So thanks a lot for helping us push the frontier. Another more light event, I say, Martin and Stephanie had kids like maybe 2 or 3 years before we did. And so when we had our first kid, we were like, you know, dying. And, you know, I remember meeting them in New York and they were saying, no, here's the thing, get a nanny because it's much better, you know, you leave the house, you come back home, the house is clean, instead of daycare. So that's a very good suggestion. Help us our productivity a lot. So thanks a lot for that advice. Okay, great. So this is, it's a pleasure, really great paper, really fun paper. So let me just get to it. Okay. Okay, but this worked actually. Okay. So let me summarize the paper in a slide. Facts are interesting. So in US, there is high interstate mobility in response to shock. This is very nice. The fact that she showed about, you know, high unemployment in some US states, people flow out of the state. In Europe, it's much less. That also we have lower unemployment in the US and more correlated across states. So the US, I'll show you in a second that we move together. In Europe, there's less of this mobility and a higher unemployment. So the question is, how much of this difference can be accounted by difference in labor mobility? You know, in US, it's relatively easy to move from California to Arizona to Texas. In US, moving to Italy to France, it's a different language, and there's a family, your mom's cooking, all the stuff, much lower mobility. Okay, so how do I assess that? They say, well, they write down a business cycle model, they call it Plucking model, but it's really a standard business cycle model with great rigidity. The Plucking comes endogenously. There's nothing special about Plucking. There's a standard business cycle model, productivity shock, and downward rigidity, so pretty much in the spirit of the work of Stephanie and Martin. And then shows that, you know, in this model, when you increase mobility from the European mobility to US mobility, unemployment is lower by half a percent, which is, you know, sizable in terms of unemployment. So that's the thing. So what I'm going to do, do two things. First, I'm going to show you some data. It's the same data that Linda has, but in a little bit different weight, which I think, so when I first looked at the data, I thought the story's wrong. It's all, the differences are all like structural, labor market, benefits, nothing to do with migration. And then if you look at the difference, actually, no, migration might be important. So I think the data totally confirm the story. And then I'm going to do a model, which is basically her model, but simplified in some dimension as a little bit, and I think it just helps us get intuition. There's nothing different, but I think gets distilled what are the key features of the model. And then I got some final thoughts, in particular in the interaction between mobility and wage rigidity, which are not obvious. And they were not obvious to me, and now I understood it because of her model. So this is the data. So top line is Europe, and bottom line is US. So you look at that, the first thing that comes say, yeah, US has higher unemployment on average. Sorry, Europe has higher unemployment. But does it really look like, it looks like, you know, there's a different threshold. So the first thing you think about, oh, it's like, no, it's a structural unemployment is different. It's not a cyclical. Cyclical, they look very similar. There's a recession, unemployment goes up, then comes down. So I thought, and maybe there's not, it's really structural. Maybe it's really, you know, unemployment benefit and other stuff. But then if you open up, and here I have US on the left, and here I just took, for visualization, the top five states. I have Texas, California, New York, Florida, and Pennsylvania. And here I have the top 5 states in Europe: Italy, France, Spain, Netherlands, and Germany, in terms of population. So now the mobility becomes, maybe mobility. So the fact that we saw higher unemployment before, it's not higher everywhere in Europe. It's higher in some state in recession. I'll focus on this. On this cycle, you know, in Spain, unemployment goes over 20%. In Germany, it's actually very low. In the US cycle, all the states go up. So then you say, if I had more mobility, maybe unemployment in Spain would be a little bit lower, and unemployment in Germany maybe a little bit higher, but on average might be lower. And that's the key thing, actually. Would unemployment be lower on average or not? And that's where the mobility interacts with the wage rigidity, and I'll go back to that. So this picture says actually mobility might have a role. So let's look at that with a model, and this is my model. So I mean, it's not my model; it's their model simplified down to the bones, I think. Now, one key difference: I'm going to have two equal countries. Why? Because mobility is a tricky thing. If you have high unemployment, migration is good for you, but it's not good for the other guy, because you get all the other people that have to absorb. In particular, if you have labor market friction. So I want to have two countries. So I want to analyze. And in these days, we all know open borders is a pretty clear, is a very hot issue. So I want to talk about that. And then there's going to be labor demand, which is standard. Think about your Cobb-Douglas labor demand, marginal product of labor. So it's decreasing in wages. Higher the wages, the less work you do, and increasing in productivity. Labor supply is exogenous. It's inelastic, but as in their model, workers can move, can decide to move from one country to the other. So M here is net migration. And then there is downward reduced wages. So wages cannot only fall a fraction on what they were the previous period. So that's the thing. This is a standard thing. Now, unemployment here is going to be, if the market clearing wage is above the limit, is zero, full employment. If somehow we need a big fall in wages, for example, there's a big fall in labor demand, then it's going to, the wage constraint is going to be binding, wage is going to stay high, and you're going to have unemployment. So that's very standard. Now I'm going to consider two regimes for simplifying. One is M is zero, no migration, so there are two closed economies living in separation. The other one is open borders. Now, open borders, there's many ways you can think about it. Workers might equalize the expected wages. Here, I'm just going to take a simplified version. Workers are going to equalize unemployment. So if the unemployment is higher in Italy than in Germany, workers are going to migrate to Germany until unemployment is equalized. They don't look at wages. I could have wages too, but it's simpler like that. Okay, how does the model work? Labor demand, downward sloping in the wage. Labor supply fixed. So we start initial steady state. The wage is such the market cleared, no unemployment, everything's great. Now, labor demand shocks hit, and boom. Productivity say falls, labor demand falls down. Now, what happened here? The market clearing wage will be this one. If wages can adjust down, it'll be still full employment. Of course, you're less wealthy, you can nothing to do about bad productivity, but there'll be no unemployment. The problem is there is a wage rigidity, so wage cannot fall below this line. So the wage has to be at this level. So then labor demand is here, labor supply is here. All this wage only falls here. So all this thing is unemployment. So because of labor rigidity, you have this unemployment. Now, closed economy, what can you do? Nothing. You just have to wait. Over time, productivity is going to recover, wages are going to fall, and eventually go to full employment. But you see the plucking. Here's the plucking. Productivity hits, boom, your unemployment goes up all of a sudden. How long does it take to recover? Well, you have to wait that the wages slowly falls, productivity recovers, so that's a plucking feature. So it's like plucking, there's no plucking, it's just productivity process. It's just language. Anyway, that's the idea. Now, what happens if you have open borders? So if you have open borders, same thing happened, but all of a sudden, people are going to migrate because nothing happened in the other country, doesn't have a shock, so these guys are going to go. So labor supply is going to shrink. Now, labor supply is going to shrink. Basically, now, maybe you still have a little bit of unemployment, depending how much labor supply is going to go out, but much less. So from the home country point of view, it's great. Now, but what happens now? The interesting thing of having two countries is what happened abroad. Because now, abroad they have no shock, but now they have more workers. Having more workers, what happens? Labor supply moves to the right, wages are going to fall. Equilibrium wages are going to fall. Is the foreign country able to absorb all the workers? Now, if the shock is small, like in this case I plotted, the labor supply abroad increases, that requires a fall in wages, but the fall is within the limit. So full employment everywhere. So the workers migrate, the other country absorb the workers, we're all happy, great. However, if the shock is big, like this, then it's going to be unemployment in the other country. So the workers are going to go, they're going to go abroad. The market clearing wage in the other country is down here, which is below, sorry, is down here, which is below the wages that was, sorry, the market clearing wage is actually is here, which is below the limit, and so it's going to be some unemployment. However, and that's a crucial part of the model, that these two unemployment are going to be smaller than the other. Why? Because basically by sending, and here is kind of the cool thing about this model. In model with wage rigidity, having people have like some reserve of flexibility of wage I can use to face a shock. And if I'm closed economy, I can only use my wage flexibility, and then I'm done, then I'm an unemployment reason. If I send worker abroad, I can use the flexibility of the foreign country, and that helps. So basically, they have this reserve flexibility that is used by using migration. So migration, it's not a zero-sum game, but it's actually a positive. So in a way, I like to think I like risk sharing. It's like pretty much, I have a bad shock, my marginal utility is very high. Well, I got some stuff from abroad. They suffer a little bit, but they have low marginal utility. So overall, it's a gain. So this is the same idea. Notice the foreign country, they suffer a little bit, the existing worker, because the wage falls. So if you're an existing worker in a foreign country, you don't really like all these guys come in because, nothing has happened and my wage falls. However, because I can use this excess flexibility that I have, I can absorb this work and overall the war gains. So that I think is the key feature of this model. Now you can take this model and put it in and do input response. Yesterday people were looking at me doing MATLAB during the session because I was trying to get this input responses. But they're kind of really cool. So you have like your productivity falls in country one, and this will happen. So for example, look at wages. Wages just go down on productivity, but more slowly because there's the sticky wage constraint. So it takes a while for the wages to fall to adapt. And then once you get to zero unemployment, oh my God, once you get to zero unemployment, then wages start going up because there's like productivity falling back. Now, if you have closed borders, big jump in unemployment at home, nothing happen abroad. If you have open border, you have much smaller jump in both countries. So there is this negative externality, but the unemployment here goes 4%, there was 12%. So overall, this is twice the overall unemployment is much bigger in the closed borders than in the open borders. So in open borders, there is, and this model kind of like is consistent with all the facts that Linda was showing. Lower unemployment in the open border, less persistent, because you have, here you don't see very well, but basically here it stays high for a while. Here it goes back to zero much faster, and more correlated across countries. Here by construction, here it's the same because mobility equalizes. Okay, so what I want to make, how much? 2 minutes, perfect. 2 more points. The first one is what can you learn from this model? I thought, okay, if you have a lot of wage rigidity, actually having mobility is good because it helps dealing with that. Actually, not so much. So for individual country, that's true. If you have very screwed up labor markets, having mobility is good because in times of a shock, you can send the worker abroad. But from a union point of view, that's not true. Actually, if you have a very, very rigid labor market, mobility is bad because you send the worker abroad, but they don't have any capacity of absorbing. So you just transfer unemployment from the home country to the foreign country. So it's interesting. It's like as a union. So if you look at the European Union as a whole, mobility, if you have no wage flexibility, mobility is not a good thing. On the other hand, if wages are fully flexible, I don't care about having mobility because unemployment goes to zero on its own. So it's an intermediate case of having a little bit of mobility, but a little bit of rigidity, but not too much. That's where mobility really, really kicks in. And so that was not an obvious point, but I think it comes out very, very naturally from the model. The final point I want to make is that, so there is a recent literature, and these 2 papers, these guys have some big beef between each other about these things, or how to explain these things. But the facts they're like really, they agree on the facts. And so this is basically, we have an unemployment rate in, say, 2000, and unemployment rate in 2020 across different locations. This is within country. And two things that you want to see is that, there's big range. So it goes from some location unemployment 2%, some location unemployment over 10%. And that stays the same, is big and persistent within the country. So that's true in the US, it's true in France and in Germany. So that suggests that mobility, I'm not sure how much mobility can do. I mean, of course, mobility might be, it's important, but these things actually help disciplining mobility. In fact, these guys can rationalize these patterns with a full mobile model. So there's like these amenities, difference in the structural labor market. So I would say this evidence of geographic unemployment might be important for them to maybe calibrate the model and think about mobility. But that's, not that invalidate their point. And so to conclude, I think these guys have a very important research agenda on the role of labor mobility in currency areas. Another very interesting area is how labor mobility interacts with capital mobility, but there's no time. And this paper really, I think, contribution is highlight a connection with labor mobility, adjustment to shocks and friction in the labor markets. And the connections are not obvious.
Sure, I'll make a couple of comments, but I really look forward to getting comments too from the crowd. First of all, thank you for your very generous comments. And actually, we went to the small open economy not really thinking about the externalities. This is really interesting, and my co-authors are not going to be pleased when I suggest that we make the model more complicated, but I think that's really a great point. The other thing I just wanted to say there is a lot of debate now about mobility and unemployment differentials and how persistent there are. I mean, it's kind of exciting. There's a lot of work on this now. And one of the things I guess I would say it's not so much on the unemployment differentials, but on the mobility. It's interesting when you look, as you get finer and finer levels of disaggregation, you actually see less responsiveness of labor flows. And this is true in Europe, that we see that, and I think it's a tendency that people move to the capital, and then once you've moved to the big cities, your next move might be to move abroad. It isn't moving within Italy, it's moving to the city, and then so it's interesting. These migration patterns there's a lot of things to work on there. But thank you very much for the comments. Super helpful.
Any questions from the floor?
Thank you. Thank you. Very interesting paper. I'm clearly not an expert in migration, but I do recall seeing some statistics on the fairly secular downward trend in mobility in the US. And in fact, I remember this nice book by Alan Greenspan on capitalism in America that he makes a really big point of that statistics as a signal of this reduction in the dynamism of the US economy. So it seems to me that if that fact is really out there, you have the perfect machinery to quantify the within country effect and how much this has limited the US economy to withstand shocks.
So let me respond to that. It's a great point. It is true, and we don't deny that there's a secular decline in migration rates. It doesn't tell you, though, what's the elasticity of migration flows to the business cycle. And actually, if you in some sense, when I said we were looking at the net migration response to the unemployment differentials, I kind of said it quickly, but we have state and time fixed effects. So what we're really looking at is unemployment high, say in Michigan, relative to the typical unemployment rate in Michigan, which tends to be high, relative to California, where unemployment rates tend to be lower. So we're really asking, does that differential widen? And when that differential widens, do you see migration responding? And it turns out that elasticity, we can go back 100 years practically. And I mean, you don't always get great unemployment rate, but if we look at employment as a proxy for unemployment, the inverse, we see that elasticity has stayed about constant. So even though the gross migration rates are coming down, the secular migration rates are coming down, the responsiveness at the business cycle frequency has stayed about the same. The other thing that is important to point out, and this is something that I think is really misunderstood, is that people point to the financial crisis. That was a point where people said, oh, people didn't move in response to the financial crisis. Well, what happened during the financial crisis? States that actually got hit hard by the financial crisis were states where people tended to go, typically. California, Nevada, Texas, the Sun Belt. Where did people tend to leave typically would be Michigan, Minnesota, Wisconsin. But it turns out the states that were hit really hard were the Sun Belt states, and the states that were hit, at least relative to our typical experience in the Midwest, was not so bad. So actually what you saw was that it's true, people didn't move, but if you forgot the long run pattern, you would misinterpret that and say that people don't move in response to that shock. What happened was it was the dog that didn't bark. They didn't move because the incentive to move had actually diminished after the financial crisis. So anyway, it's a kind of a subtle thing, but I think it's missed in the discussion of the data.
Yeah, I'm sorry, no.
So I guess my question is migration less important now? And so what we haven't talked about yet is remote work. And if you have the option to work remotely, then you maybe can still have your mother's cooking, but not relocate. And some of the other costs associated with mobility wouldn't be incurred. So how do you think about that in this context?
Yeah, so the main thing I think about it is heaven help people who work on statistics on labor migration, and because it's going to be really complicated and it's going to take a while to shake out. I mean, even though people are working remotely, I think we're shifting to an equilibrium where 3 days a week you stay at home, but your boss still wants you to come in 2 days a week. Are you really going to commute 500 miles for those 2 days a week? So I think we don't know yet what the pattern is. Is it that people really aren't going to live near their job and they really are going to be in a mountain cabin and everything they can do is remote? Or is it that they have the luxury now and it's also going to have an impact on wages? I mean, we're already seeing that you can, part of the premium to the worker is increased flexibility. And so there's going to be more adjustment on the wage side. But I'm speculating here. But yeah, these are important things to think about going forward. Oleg.
So yes, I had the same question that Andres had.
Let me give you.
Oh, thank you. The financial crisis, that was super illuminating actually. But like a bigger question is levels versus cycle, right? Like you think that if there is such alignment of cycle, right, like Fabrizio showed and why there is no smoothing out of the level differences, right? Why people are quite elastic in terms of moving, to cyclical differences, but the Rust Belt is so persistent and stays persistent for 40 years. How can you reconcile that? What needs to be put in the model?
No, this is a very good point, and I'm gonna punt a little bit. So I think, I look around this room and I think probably none of us are living anywhere near where we were born and raised, and we've all moved around. That's, we're very responsive to labor opportunities, and I imagine, so this is a long way of saying, is really gonna have to dive into who is it that's left behind. So when I said that people respond, that doesn't mean that there aren't pockets of the country, we know there are, where people still don't move, regardless of how high unemployment is or whatever the opportunity is, they're not going to relocate. But at the margin, are there people who are making the decision to move? And I guess that's what this model is picking up. But I think you to fully understand structural unemployment and unemployment over the business cycle, you kind of need both. So our model is too simple to do that, but it's a great point. It's a great point. I think you need demographics, you need something a little bit. I will say we have looked at these elasticities for different demographics, and it's the way you would expect that both women and men of prime age, working age, are the ones that are responsive. Older workers, much less responsive when you look at these cyclical fluctuations. Yeah.
If I can add, what I find remarkable about Rust Belt, it's multiple generations, right? If you thought that young people would move out, but it's been more than 1 or 2 generations at this point, and so that's the surprising part.
Yeah.
I just had a question about measurement, thinking across countries. These unemployment rates are from surveys. There can be cultural differences in your willingness to even admit that you've looked for a job and haven't gotten it. Do we have any evidence on employment to population ratios or any other way to think about that?
So these aren't, I mean, these are the Euro area unemployment statistics at the national level. So you're saying they're based on surveys, they're not actual unemployment?
No. In order to get unemployment rates, you ask whether you look for a job and so on, and there can be cultural differences in how you would answer questions like that.
I don't have a great answer to that question, so we were just pulling the Euro area statistics.
If you look at employment rates, have similar pattern.
Yeah.
And employment population have similar pattern.
Thank you.
No, I did that.
Yeah. That was going to be your cheap question, right? Yeah.
So I think this is a bit like maybe overstepping into the tyranny of the applied micro part, but I really don't know. But I was thinking like so perhaps maybe part of the explanation of where rigidity is unionization, which is different. But of course, maybe it's correlated with something else. But maybe one could think about some sort of shift share instrument to think about industry structure. Then you have states. Then you have different unionizations, which is sort of like gives you the rigidity, and that's sort of like you instrument the rigidity with a shift share with a fraction of unionized industries. Because at the end the model is kind of like a Todaro. I mean, it's like a modern up to a state of nature Todaro type of model. You will go, you are unemployed because the wage is sort of not flexible. Then it will be nice to have a shock of that it will be differential on the flexibility. So I was thinking perhaps that or some other smarter way of doing it.
That's a great point. I'll think about that some more. I don't have a ready answer for you, but that's a great point. Yeah, I mean, we always run into this question in this paper and in the previous paper, which is, why is labor less mobile in Europe, and are these things that can really change? I guess the way I kind of flip that question is that those are the rigidities that exist. We're doing kind of a reduced form to capture them, and in some sense, those are the opportunity costs of being in a currency area where you have those rigidities, and they are what they are. They might be language, they might be other barriers that prevent people from moving, for sure, but I think policymakers should confront the fact that those barriers exist, and that's going to make it harder for the economy to respond to shocks, and this is the opportunity cost of not having other prices that can move.
Any more questions? Thank you.
Okay, right before we move on to lunch, I just want to make a short announcement. We have added another policy panelist at the end of the day, and so in order to not have you stay later, we are shortening lunch by 15 minutes. For all of you, that changes nothing, because as you see, we're in the same room. You can continue to eat until 4:15 p.m. if you want. But I would encourage that we help encourage the people who are speaking next, those next presenters, to go ahead and get your food first, because you've gotten a shortened time before you go up and speak. So thank you so much.
Test 1, 2.
Okay, so next decade, if you got your PhD before 2010, we can come up. Yeah, I said before 2010. Oh, you said? Yeah, before 2010. We go back 10 decades.
One of the presenters showed me a paper with wedges between the price of the exchange rate in Switzerland and in Russia, with a fiscal surplus. Very much more conversation of their yeah. That's what they told you the other day at lunch. So that no, what I'm saying is that there are countries that have exchange controls.
Sorry, next decade. All together. I guess it's everybody. Everybody. Yeah, everybody who got the PhD after 2010. And then we are starting the next session. Can we see the next session as well? Yeah.
No, you're staying here.
Yeah, the next session, yes.
I wish I could. You're staying here. Juanpa debe estar en el baño conociendo la... ¿Dónde está el boludo? Ah, ahí está.
Voy a llamarlo por Mari.
Ah, pero me voy a traer el iPad.
Acá tenemos la
Okay, we're about to start. Please take your seats. Fasten your seatbelts. This is going to be rocky. Okay, it's my pleasure to present Fernando, a great friend, an amazing economist. Fernando, the floor is yours.
Well, thanks a lot for the invitation. I was thinking why I was invited here. Most people here, they like great contributions in macro, monetary, international. And then after reflection, I understand why I was invited. There are two reasons. I think I'm the one that knows Martin the longest, and also I have made a very important contribution in notation to the work of Martin and Steffi. So let me explain both things. So, so this will be my contribution, not the way that Martin has contributed to my research, but how I contribute to their joint research. So first is, we met in December of 1988, 36 years ago. There were 7 Argentinians taking the GRE in economics. If you looked in one of the pictures yesterday, Eduardo Rodes was there, next to a very young president of the Central Bank of Israel. And then, I really thought, I was thinking about what Mike says about Martin, because Mike says that when Martin solves the exam, it really caught Mike's eye in terms of the quality of the exam. So when I was doing the GRE, my eye was trying to get into the exam of Martin. But it didn't go very well. So Martin went to his choice school, which I think it was a very good choice. And I didn't. I went to my 4th choice school. It worked out well anyway. I have a job. I'm very happy with my life. But from there on, we saw with other friends, with Marcelo Veracierto, we know whom to look after. So anyway, so that's the way I met Martin. And then there is my contribution to their notation. So as we know from yesterday from Steffi likes a lot the south of Argentina and the lakes, and there is a very nice glacier. And there is a glacier that is known to all the Argentinians as Perito P. Moreno. So Perito means, some sort of advice or like someone that knows something about. P is some mysterious name of this person, and Moreno is the last name. So this name is mysterious because it's a very strange name. It's Pancasio. So anyway, and then what happens is that there was a meeting where finally Martin is really asking me a question about research, I thought. And then he called me about this question of, I have this problem that, this issue of Steffi likes a lot this lake, this glacier. He likes a lot then to honor this person with the name Pancasio for their joint production, for their son. So I was thinking, well, it's a very weird name in Spanish. So I was called as a witness to explain the strangeness of the name. And that was my contribution, because I think that. So having said that, I want to thanks again, avert the issue, and then happy birthday again. And I'll go and also try to follow Mike on the topic. Anyway, so this is a paper with, So this is a paper with Ferrara, which is a student at Northwestern, Gautier, Levihain, which are 2 economists in the Bank of France, and Francesco Lippi, which a lot of you know. Okay, so, and forgot. It's not that hard. Anyway, so. Anyway, so what is this paper about? So, okay, so in a class of models, of state-dependent models, this is a proposition that holds in this class of models. What is this proposition? So the first part is there is a delta, which is a once-and-for-all shock in the nominal cost. This will come in simple models when there is a cost that increases nominal wages permanently. And then Yj will be the output of an industry, of the industry J. And then the integral is, so the Yj will be the impulse response after a once and for all shock on money, or like in nominal wages. And in each industry, there is some heterogeneity of firms are following some state price dependence. Then you look at the area under the impulse response. And CIR is for like cumulative impulse response. And in this set of models, it will turn out to be that is for a small shock. So when delta is small, it's a first order approximation. It's equal to delta, the size of the shock, then the number 6, epsilon j, which is some sort of elasticity of the demand for this particular good. And then there are this ratio, which is a ratio of two statistics. That is what you will get in a steady state for the distribution of prices. So the idea is the left-hand side is some sort of macro aggregate. Some idea of how big the impulse, how much is the effect of this nominal shock in real output. And the right-hand side is the size of the shock times a statistic that will hold, I will argue, in a large class of models. And this statistic is sort of the ratio between two moments. One is the kurtosis of the distribution of price changes. Think about like in a stationary state, look at the distribution and see whether there are a lot of very large and a lot of very small price changes. And the other one is a frequency of price changes. And the fact that the frequency appears there, we should all get, certainly since the work by Guillermo. And this idea that what kurtosis measure in this class of models is some idea of selection of prices. And I'll talk briefly about a set of models in which kurtosis could be high, kurtosis could be low, and then this will have more or less effect on output. Because the lower the kurtosis, it turn out to be that then there will be sort of, it will take longer, even with a model with the same frequency. And I want to apply this across industries. In the models I'll show, equivalently, you could think about this object here, which is the integral of the prices after the shock. And this integral of the prices after the shock, you compare to what would have been if it would have been flexible prices, which is delta times cap t. Let's say you go up to cap t periods. Delta t will be if prices will be flexible, because the shock is once and for all. So, and then the idea is that the difference between these two is summarized by this number that doesn't have the epsilon. And this number is kurtosis of frequency with a minus, because the idea is that the more sort of lower the frequency, then the higher is the correction that you have to make, meaning that prices are less flexible, okay? And then how much is the correction that you do relative to flexible prices will be kurtosis over frequency. So this is a theoretical proposition. I'll talk briefly about models where this holds, and I will sketch one model. But what we want to do in this paper is we want to measure the left-hand side across industries and also the right-hand side across industries, and we want to do a cross-sectional regression. So that's what it is. Okay, so very briefly then, we're gonna look at CPI. This could be CPI across industries or PPI across industries. And then we're gonna do this from French data because it's the data that we have access to. And we're gonna run this cross-sectional regression. So now briefly, kind of the models where this holds. So in some stylized version of Golos and Lucas, which is, anyway, I'll describe it. Some versions of what is called the Calvo Plus, which is sort of like Golosov and Lucas, kind of mixed with Calvo. With some probability, you could change prices, and otherwise you have an SS rule. And the idea is Calvo Plus because it's Calvo plus sort of Golosov and Lucas, so it's sort of in between. There are some sort of more general versions of these models proposed before by Cavalier and Engel, and I'll talk about one of these, where there is maybe like a continuum of fixed costs that you will draw. I will sketch this model. Then there's some version of rational inattentiveness in which mostly the work by Ricardo Rice and some versions of the work by Mike, Akonstein, and Nakov, for which the same proposition will hold. And then there is also models that are state-dependent, but where the distribution of opportunities to draw prices, instead of being constant probability per period, is any survival function. Like the work by Carvalho or the papers by Ivan, they also hold, the same proposition holds here. In that sense, this is a sufficient statistic that for each set of models, you compute kurtosis frequency, and for this object, this is the only thing that matters. And then there's also versions like in Virgilio's thesis, in which you actually pay a fixed cost to change a set of prices. So sometimes referred to the multi-product. So for all these models, this will hold. I will sketch only one of them. Okay, so some theory background, some empirical specification, then something about computing the, some empirical specification, then computing the left-hand side, computing the right-hand side, running a cross-sectional regression. If there is time, I'll go through also like a particular industry. Okay. So here's sort of this is one of the versions of the model. It's based on a paper. It's really based on Cavalier and Engel. It's but you know, we work on this in a paper with Francesco and with Alexei Skolkov. Okay, so this object here is the value function for a firm. And the idea is that this is very similar to a lot of the things that Mike talked yesterday. So X is going to be the difference between the price that you would like to charge, P star, and the price that you're the markup that you have and the markup that you would like to have. How is that the markup change? If you don't change prices, it changes because there are idiosyncratic costs. So X is moving by itself if you're not changing prices because the cost is moving, and hence the markup is moving because your price is misaligned. Now, the period return is, we are minimizing. We are very pessimistic people. So we are minimizing relative to what the optimal profit would have been. And then there is a quadratic approximation. The first order approximation is flat by being on the top. So this is a coefficient times the markup deviation square. Then the shocks are Brownian, so you need to do expected values of this, and this is this term on the value function. And now with some probability kappa per unit of time, then you draw a fixed cost. You draw the fixed cost from the distribution G. And then you need to choose, should I go and adjust? And in this model, without trend inflation, you will adjust to the markup that will be the static markup. So if you adjust, you pay the cost. You move to now being with the best markup, which is 0, and then you have this capital gain. Loss is a negative number, but let's call it capital gain. Or not. You choose not to do it. So this is all under this integral. And this happens randomly because kappa times dg is the probability per unit of time that you draw one of these costs. You always have access to a cost that is kind of larger that you could always use. Not probabilistically, but this is always there. So you choose the best of the two. Either you adjust, so you go directly to this value function, plus you pay the cost. This is done in float terms because there is an R on the left-hand side. This is our continuous time, I forget. It's just intuitive. It's just either you adjust, you pay for sure, and then you take your chances to see which type of cost you get. Okay, so these models will give you what Cavalier and Engel call a generalized hazard function, which is a hazard function as a function of your markup deviation. This is this lambda function there. This tells you when you're very far away, you will actually adjust even if the fixed cost that you draw is very high. So you could count the type of fixed cost that you will get. So if you look at the formula for lambda, is G, which is the CDF of the cost evaluated at the cost that will make you indifferent between adjusting and not adjusting, which is the Bx minus B0. So that object, of course you need to know the value function, but if you know the value function, you could compute this lambda. Lambda is not observable because you don't observe the markup deviation. But that's the workings of the model. And there are 3 examples here. This is Calvo, which is a constant. This is Golosov-Lucas, which is you don't adjust, and then you adjust with probability 1 when you hit 2 barriers. And this is some other one in between. And any function in between that is increasing can be rationalized with a G. So we could draw any function that we want there, and then we prove that then there is a distribution that will rationalize it. But I dropped 3 of them that are representative. Okay. Then what's going to happen is that given this function lambda, you could compute the frequency of price changes. Well, you could compute 2 things. The cross-sectional distribution of the markup deviation, which is this object F. Some firms will be deviating a lot, some firms very little. And then you could compute the frequency of price changes, which is the probability of adjustment times the number of firms with a markup deviation. And you could also compute the distribution of price changes, which is something that in principle you could observe. The distribution of price changes is this object Q. Without getting into the notation because of the time, here are 3 examples. This will correspond to Calvo, in this case. It's very peak around very small cost, and it goes down with fat tails. It's a Laplace distribution. This is the one that corresponds to, with the 2 humps, to quadratic, for instance. And this is 2 mass points are the one that correspond to Golosov-Lucas. And there's a bunch of them in between. Okay. This is in principle observable. So now let's think about the shock. You start with some distribution of markups, And this is an MIT shock. What happens is that it's once and for all, it will increase wages once and for all. Then you shift the initial distribution, because you have a distribution, your markup used to be 15%, but now wages have gone up, say, 1%. So now your markup is actually lower. So you shift the entire distribution. Then each firm follows the same rules up to first order. We prove that this is the case. And then, so you keep the same decision rules, and then you do aggregation across them to compute what they do, and you compute the impulse response. So we do that in several papers. And the difference is that notice that these are examples in which you have the same frequency of price changes, but in this case, the impulse response of output, this will be the one from Golosov and Lucas, and this will be the one from Calvo. And the area will be 6 times bigger. And this 6 times bigger is because the kurtosis will be 6 times bigger. And in general, the formula you get is this one that is proportional to delta divided by 6 times kurtosis over frequency. Remember that kurtosis measures how many very small relative and how many very large. The idea is that this is selection, because in Calvo, you change it because whatever. You're not selected. In Golosov and Lucas, you only change it when you are away. And you don't tolerate very large changes because you act. And you don't change when markup deviations are very small because it's costly. So it's very, very selected. That's why there are 2 mass points. And in Calvo, it's sort of the least selected that it could be because it's totally unrelated to the markup. And the idea is that kurtosis and the end up picking this. This is some sort of theoretical result. Okay, so this is just the same. I'm plotting these lambdas. I'm plotting the steady-state distribution of price changes. And then I'm plotting the 3 impulse responses. You see, these have the same frequency. So this is Calvo, this will be quadratic, this will be Golosov and Lucas. Okay. So this gives you this result. If we measure impulse response of output as 1 over some elasticity of the demand, this is a combination of demand and supply, but some elasticity, this is the increase in nominal cost, and this is the increase on the prices across all the goods in this sector. This will be the change on output. This is the accumulated version. And then we do a first order approximation of this object that is only for a small delta. And we prove that this object is delta divided by epsilon times kurtosis divided by 6. So, okay, so I try to give the intuition for this, and this is some formula that measures selection. So that's all. I'm happy to, okay, so there's some proof. This case is so easy that you could actually prove it in, if we had 5 minutes, but we don't. Okay, so this holds there. As I said, it holds in the, there's a version of the Calvo Plus for multi-product. I think the discussant will talk about that one. There's a version with rational inattentiveness. This proposition is there. There's a version with strategic complementarity. There is a bit different, because with strategic complementarities, the barriers will change, but it's interesting, it's a multiplicative adjustment. So it will be something that will depend to the degree of strategic complementarity, but it's still times kurtosis over frequency. Then there is also like typical impulse responses. They are not like once and for all shock. They're more like an interest rate shock that we think that identifies a monetary shock that maybe changes prices in the long run, but it also has like a predictable part. So we need to think about how to change this result. You know, if we're going to identify a shock, a monetary shock with an interest rate shock. Let's say that this is what we do in this paper is we do that part. And this formula has to be corrected. There is a factor that tends to be very small. Let's just say that. I don't think I have the ability to do this. So this is going to remain a mystery. But I'm happy to do that later. Now it will be interesting. But if that will be interesting, I'll do this. Oh. No, they must have done it there. Okay, fantastic. So this is what happened. Now I need to explain it. So what happens is that, so now you have a monetary shock. Okay, very fast. So you have a monetary shock, and the monetary shock decreases nominal interest rates, and then they go back. So it's a monetary shock that of the type of monetary shocks that we estimate on VARs. It has both the typical pattern of interest rate, but also has a pattern in terms of how much you need to adjust this formula. So maybe briefly the next page. This I could do myself. Yeah. Okay, we went back. The point is that then you could correct this, and this depends on the so given the size of the shock, you need to think of how big is the change on interest rate relative to the shock. And what we do is we actually get a formula for these models for that object that depends only on kurtosis over frequency and in the persistence of the shock. And what we explore is where is the upper bound for this, and it's a small number. You need to correct, anyway, let's just say a small number. So now let's keep going. So that's it, because now we have this formula. Now I define the cumulative impulse prices as this object, and notice that this means that if I go up to period t, this is a contribution on aggregated output, which is, I'm just defining this object here on the top, 1 over epsilon delta integrated up to t, so I could link the impulse response of output to the impulse response of prices, and you get the formula that's here in between. This is just like literally like dividing 1 by epsilon. This doesn't have the epsilon, and it has this intuitive for us, meaning because this is flexible prices and this is the correction. And you could also expand this into 2 terms, one that has kurtosis separated with frequency. And what we're going to be doing is the following. We're going to be replacing this by estimates, and then we're going to run a cross-sectional regression. So we're going to replace them, the top equation, by estimates. They're going to have some error. The error comes from, one of them is the error from estimating a VR. The other one is the sampling error for computing them. These errors will imply that the R-square may be very low because this is very estimated with noise. The other will be sample variability. They may or may not give you some attenuation bias. We could discuss this, but we're going to replace the theory by estimates. Now we have a proper regression. We're going to run the regression. So the next point is how we're going to construct the impulse response of prices. Then kurtosis over frequency are just sample estimates, and then just run the regression. So how we're going to do this, we're going to use Bernanke, Vauban, and Elias because it sort of comes with a large factor model. So how am I doing in time? Okay, so it's a large, so remember, this is okay. So 2 things. So we measure the left-hand side, it's about aggregates on each industry. We measure the right-hand side, it's in each industry a moment of the distribution. Then we're going to run this cross-sectional regression. Okay, let's talk about measuring the left-hand side. The left-hand side is a VAR. So we're going to use something, we don't want to innovate, plus it's not that we know, it's not our comparative or absolute or any type of advantage. We're going to take it out of the box and do it for French data, okay? So we're going to use some interest rate shock. But we want to do this particular version because we want to have a very large steady space to have maybe 300 industries or 120 industries. So it's natural to use this type of VR that has a large factor structure. So we could extract the prices for every single industry. Is that okay? That's kind of our choice. And the second one is just computing these moments. That's relatively straightforward. So very briefly then, when we run these regressions now, these are alphas and beta, wherever they are, we have a theory of the errors, sampling error plus error in the estimation, and we have a prediction for the parameters. The constant should be, okay, we're going to do this for t finite, like a large value of t, so the constant in the regression should be cap t, and then the intercept should be delta divided by 6. We're going to take delta number to make it simpler, minus 1%, so it will be 1/6. Okay? So the idea is that beta should be minus delta divided by 6, so 1%, it's 1/6, and then these two should be equal and of opposite sign. Okay? All right, so that, now if there will be a strategic complementarity, or if we think the shocks are none for all, there is a correction, but I don't think I'm going to get into that. Okay, so we used to, okay, so I had to say one more thing. So what are the main features of all these models? There's some sort of Brownian shocks. There is a random walk from the markup if you didn't change it. There is some mechanism that gives you to change prices. And once you change prices, in the words of Cavaliero et al., you close the gap. All of those that are from my age, they will remember Cavaliero and Engel fighting against, closing the gap. Anyway, not our best, whatever. So, but you know what I'm talking. So closing the gap means that you change the prices and you go to the kind of static optimal. So these actually exclude excludes a lot of models in which you do like some temporary prices like sales, so on and so forth. Okay, so I just want to say this for the interpretation of the results. Okay, so we're gonna do this for CPI and PPI. This is a standard series. We're pretty much copying what these authors have done. So we're gonna have a factor structure, an interest rate. This will be a small number of factors, and then you have a large number of series. If we're particularly interested in having industrial prices and production. And then at the end, you have the impulse response computed this way. This is really identical from the sort of this type of factor models with two changes. The two changes that we do is we impose that the shock will be like, the prices will, I mean, we want to normalize the shock. We would like to have the shock to be, say, Cholesky or maybe innovations with futures interest rates versus actual rates. But we want to also measure what is the long-term impact on prices. And we also want to have that all the industries at the end up with the same increase on prices. That's a restriction. It's kind of like a Blanchard-Quine in steroids, because we are doing this, imposing this for every single industry, which is what the model will identify as a nominal shock. At the end, it will not change the relative prices of outputs across industries. I had to say this. Mike was talking about industries yesterday, but I'm calling that products within an industry, and it may be confusing. But anyway, the slides were prepared before, otherwise I would have changed my notation. Okay, so this is what I said. We get some impulse responses that are whatever, they're a bit jaggedy, but what can we do? But they are kind of the standard thing. There is a, interest rate goes up, output goes down, prices go down eventually, and I think it's kind of reasonable. Then this is the impulse response of prices for each of the industries, for the CPI and the PPI. And remember that what we're trying to do is we're trying to link this to observable characteristics of the industries and nothing else, okay? Very heroic, I think. Now, second part, we go to each industry and we measure the frequency of price changes. That's relatively easy to do. And we measure the kurtosis of price changes. It's just a moment of the distribution. This itself has a cross-sectional distribution. Some industries have, more flexible prices, less flexible prices. Some industries like gasoline, they have price changes that look almost normal. Some industries have price changes that are very large or very small, whatever. There is some heterogeneity between that. This is a histogram, one for PPI and one for CPI. Then this is a regression for PPI. So this is kind of the number. So here we are doing this for monthly data with a horizon of 30 months. So, 36. So this should be like 36, and this should be 1/6. So there are several columns. So I like more these two columns. I like Cholesky because it's kind of traditional, very classical. And then I like this one, which is high frequency. And both of them impose the long run restriction, which is sort of what a nominal shock should do in these simple models. This doesn't have basically that imposed. And then you could also have fixed effect at the level of a higher industrial classification. So you're using the within industry. I don't think that that's that reasonable. Anyway, but I'm showing this for whatever, so you see what you get. So these numbers are not that different than what the theory predicts. This is kind of like 1/6. This is kind of like 36. The R square is kind of low. The fact that the R square is kind of low is we should expect, if you were to compute the variance of the estimate of the SEER, because then you will have a theory of the R square, as typically you do. You need to have a theory of your errors, where they're coming from. Okay, this is now CPI. It doesn't work that well. You see, they are significant, not in the cases that I like more also, so I'm not going to highlight that a lot. I'm going to ask for forbearance like the other presenters, and I was anticipating it. So, so it worked much less well for CPI. CPI also has law of sales, which these models do not have sales. They will change a lot of these statistics. If you remove sales, it improves marginally, okay? So, but I just want to show you, of course, we could have written the paper without showing you CPI, but that would be, I think, kind of bad practice. Also, we could have said, well, we don't have output, that's why we don't do it. No, okay, we like to show you the bad things. Okay, so it works less well, but it works a little bit less embarrassing, less closer to it when you actually remove sales, which is these are two versions of removing sales. Okay, so now this is the case in which we run this with kurtosis and frequency separately. And the prediction is that the coefficient should be same magnitude and opposite signs, which is something that you could test here, and it will be, depending on how stringent your criterion is, it will pass this sort of test. You could see it, this is a -7 and 8.8. I think that these are, again, my favorite versions, okay? All right, we could do some other things. We could do the same for CPI. Let me skip it. We could think about other moments that should not matter and whether they're there. Let me skip this. And instead, let me skip the discussion about whether the R-squares are reasonable because they are low, but there's low measurement error in the left-hand side variable and very little measurement error in the right-hand side variable. So we have small attenuation bias, but we should have like low R-squares in principle. Okay. So let me just not talk about this and very briefly show you some other data, okay? So this data is kind of crazy. This is not really important for macro. This is gas stations. So this is for gasoline. Look at the impulse response to a shock in Rotterdam prices into 4,000 gasoline stations in France. It goes to a pass-through in 40 days. Okay, fine. This is for scientific purpose, no? But this is a pass-through of a shock in Rotterdam prices to shocks on gasoline prices in gas stations in France. This is if you put the sear versus kurtosis with a scatter plot, you will see that it's and the slope is kind of 1/6. And this is if you do the partial scatter plots. Here there is much more data because there's only 10 years of data, but these 10 years of data have a lot of price changes. And you have 3,000 stations. All of them are very similar, but I think you see the signal here, there's much less noise. This is some regression, so now let me conclude. So we use this cross-sectional data to test this sufficient statistic proposition. The evidence is sort of consistent with predictions in PPI, less robust for CPI. The idea is that kurtosis of frequency shows up with roughly the same magnitude that it should be, and we don't reject that it's different from kurtosis and frequency. And other moments, they don't seem to explain much of the remaining part. And CPI doesn't work well, works a little bit better if we remove sales, which is kind of consistent with the theory. And that's it. If you go there, you need to put it back.
Okay, Lupu. While you get ready, I would like to point out that in the end, Fernando went to a good school. He avoids non-convexity, so that's why he was randomizing between the two screens.
No, porque me pusieron todo el tiempo uno.
¿Te dejaste presionar?
Sí, soy un cabrón.
Usaste 21.
Sí, boludo, ya sé.
Nadie, que acá nadie habla castellano. It will come.
It will come.
Yeah.
It's like a field of dreams. If you send the slides, they will show up.
No, they might not. So far they did.
Pero estamos tratando de CPI en otros países.
La mayoría.
Claro, mayoristas. Pasa que no solo sé si eso es como la teoría no es consistente. Pero puede ser otra cosa, que es todo un desastre y que sea de casualidad. No.
No, ¿para qué se
el precio en el futuro. So pensé que son el oil price en Europe. Sorry, tendré que explicar.
It's just only 77 slides. That's why it's taking a while.
And 2 movies.
Full length.
Could I give 3 more papers? I could have given 3 more papers in between.
No, y bueno, tendría que terminar.
All right. So I would like to start by saying thanks to Pablo, Vivian, and Stephanie for inviting me to discuss this paper. I would like also to say happy birthday to Martin. I have met Martin and Stephanie on a very few occasions, but both their advice and their kindness and also their contribution to the literature has helped me become a better economist in general. So I'm going to, because we are short on time, I'm going to just jump into my discussion. So I learned a lot reading this paper. It's a great paper that builds on two other papers by Fernando. One that he wrote in 2014 and another one in 2016. And these two papers are very important in order to understand the contribution of the paper that he presented today. So the equation that you can see here on the slide is the key equation that you have in Fernando and Lippi and the Bion paper in 2016. And this equation here describes the cumulative impulse response of prices following a monetary policy shock of size delta. And what it says is that the gap between the cumulative response on the sticky prices and the flexible one depends on two sufficient statistics, the kurtosis and the frequency of price changes. So for the frequency of price changes, I think it's very intuitive why it matters to understand the cumulative response of monetary policy. The idea is that if prices adjust more frequently, then it means that they are more flexible. So it's less likely that the gap between this cumulative response following a monetary policy shock and the one that you have on the flexible prices will be large in absolute value when you look at the magnitude. The one that is less obvious is the kurtosis. And the kurtosis here describe the relative, how often we observe extreme values relative to the intermediate values. And if we think about, if we take two models, two extreme cases, the Golosov-Lucas model where we have the mass at two different points, the basic one, and we think about the effect of monetary policy shock. So if you have a very small monetary policy shock, it's very unlikely that it's going to push the gap toward the threshold and then induce a change in prices. However, if you take a Calvo model with the same frequency of price changes, because at each point in time you have a probability lambda of updating prices, then you have that, if you have a continuum of firms, you have that a fraction lambda of firms are going to update, and then you have that this will have a larger impact. In the case of the Calvo model, you have a kurtosis of 6, and the Golosov-Lucas, you have a kurtosis of 1, and that explains basically the numerator here. In this paper in particular, what they do is that they first have a theoretical contribution. They extend this analysis in the 2016 paper by assuming now that we also have a transitory predictable component for monetary policy shock so that the wage doesn't jump once and for all and stay there. And then they use that for the empirical investigation of whether these sufficient statistics hold in the data. And the other motivation for this, why they want to test empirically this is because you have other papers in the literature like Bailey and Blanco in which they show that if you had drift on the shock, on the Brownian shock, then you have different sufficient statistics. And here they are trying to show that this one is the most relevant one when it comes to adjustment of prices. So for my discussion, I'm going to start by giving you a brief overview, a large overview of the theoretical results, both in the 2016 and 14 papers, and the recent one, very briefly. And then for the comment, I'm going to focus on what they can do next regarding this paper because it's already published. So in order to think about the effect of monetary policy shocks on distribution of price changes, we need a model that can help us get the distribution of price changes that we have in the data. So here you have the distribution of price changes in France and in the US. And you can see that when you use a Laplace distribution, which has this tent shape, you can kind of match this type of distribution. But when you think about the canonical menu cost model, what you have is that you have a threshold or a threshold rule that defines the inaction region. In this inaction region, you don't do anything, and then once you hit the threshold, you just change it. So what you have in that type of menu cost model, the canonical one, cannot help you deliver or match these small changes that we have in the data. So what Alvarez and Lippi did in the 2014 paper is to show that in order to get exactly this shape, you need two ingredients: a random menu cost and a menu cost, and you also need the fact that the menu cost faced by firms applies to a bundle of n goods. This is the same trick that Midrigan has in his paper, but I want to tell you why you also need this random menu cost model and what is the difference between the two models. So here is the description, a very simplified version of the model. They assume that firms can produce a single good using only labor as the linear technology, which implies that the marginal cost will be the wage. And this is also important for the result for monetary policy. You have idiosyncratic shock. Of course, you need a Brownian here. The variance is going to be sigma square. And then the firm is going to face a demand with constant elasticity eta. And this comes from the fact that household will have CS preferences over the different varieties that firms are going to produce. And then for the price setting, they assume that each firm are going to, the price setting problem of the firm, each firm are going to face this random menu cost with probability lambda. They are going to be able to update that for free, update the price for free. With probability 1 minus lambda, they have to pay a cost. And then if we think about what happens in a model where we don't have these frictions, then firms, since they have monopoly power here, they are going to set the price as a markup over the marginal cost, and the markup will be just eta over eta minus 1. So they are going to define here the price gap. So if with probability lambda you get this Calvo shock and it allows you to update the price, then you want to close the gap. Otherwise, you cannot update the price. So we can basically rewrite the profit function of the firm in terms of this, following a second order approximation in terms of the price gap, P square. And B here, the coefficient that multiplies that will be proportional to the elasticity. And what this equation here tells you, the Bellman equation, is that the value of the firm will be given by the instantaneous loss, and then you'll have a change in the value, the expected change in the value, which will happen for two reasons. Either because they are hit by this shock, and they can freely update the price, in which case they're going to close the price gap, or you have this change in you have a productivity shock, and that is reflected in the second derivative of the price multiplied by the variance of the Brownian shock. And at the boundary, at the threshold here, basically P bar is the rule for the threshold that's defined in action region. At that point, you are going to update your price, you close the gap, and then you pay the cost fee outside. So basically, with this simple model, we can describe what the distribution of price changes will look like. So basically, when you hit the threshold, you are going to update the price, and this will happen with a mass 1 minus L. What is L? L is the Calvo-ness of this model. What it means is that basically, if you look at this L function here, it's the ratio between lambda and sigma square over P bar square. Lambda is basically the frequency of free adjustment, and sigma square over P bar square is the number of time or the frequency of adjustment in a standard menu cost model where lambda is equal to 0, and the rule is given by P bar. So with that, we can define the distribution also when we are in the inaction region when lambda equals 0. And you can see that this distribution takes this form, which depends basically on the Calvo-ness and this ratio here. Simple math calculation shows you that basically the distribution is going to peak at delta p equals 0. The shape is going to be high peaked, and you can clearly see that the distribution, the kurtosis here is going to be increasing in L. So basically, it's going to be increasing in lambda. The frequency of adjusting the prices freely, so the Calvo-ness of the model. So basically, with this simple model, what we have is that we have a distribution that is symmetric. It peaked exactly where we want, so we can kind of get the small changes that we have there. The issue now is that we have a mass here, and to correct for this mass, what they show is that you can just basically increase the number of products. It makes this mass disappear, but the issue is that if n is not large enough, let's think about a case where n is equal to 2. Then you are in this type of sphere, and you have to update one price, so basically you project that on the plane, on the plan, and what it implies is that when you are next to this steep part of the sphere, you have like a large mass. Otherwise, in the middle, you have a small mass of price changes. So basically, the shape for n equals 2 will look like will have a U form or 2 bumps, which is what Fernando showed earlier. And as you increase n, for example, 3, it becomes uniform extra, which is exactly what we have here. So let's say I keep the calibration. So here I'm redefining the calibration as a frequency over the number of changes. If L is equal to 0.2 and I start changing the number of products, I'll get closer and closer to a normal distribution, but I don't have this high peak. So to get this high peak that I want, I need L to be large. And even for small n, if you increase the calibration, you can get exactly the distribution that you have in the data. So this summarizes basically the paper, the earlier paper. And what they did here is that they now need to think about monetary policy. So they're going to put a little bit of structure on household side. Household will have these simple preferences. Optimality condition says that the wage is proportional to money supply. If I increase money supply by delta, I increase the nominal cost of firms, and they want to update the price. Perfect. So the effect, so basically what they, and with that, they can now characterize exactly the increased response that you have for aggregate output. So it will depend on the change in marginal cost and the change in the price index. We can rewrite that in terms of the prices. I think Fernando did a great job explaining that. And then in this paper, they add this component, this extra component, which is the transitory part. This was for permanent shock. So in that case, you have extra terms here that I didn't show, but they all depend only on the calibration and the persistence of the shock. So the sufficient statistic remain the curtices and the frequency of price changes. And they take that model to the data. So basically, the key point that I want to emphasize here is that when you look at the PPI, you can see that beta equals 1.6, which comes from the previous slide here, when you have a 1% change, hold for the PPI, but it doesn't hold when I look at the CPI. Even if you remove for sales, you still have that it becomes, for some, under some parameterization or some identification, it does work, but it doesn't work all the time. And the same thing will happen when you look at the other model when you want to compare the two betas. So my discussion will be centered around an alternative explanation for the lack of robustness for the CPI index. So the first thing that I want to show you is this figure that I took from Eichelbaum and others' paper, in which they are looking at the distribution of price changes in the data. And what they explain in that paper is that if you remove let's say you clean the data and you get rid of the measurement errors, the frequency of the median price changes in the data is about 30%. If you do a simple back of the envelope calculation for the sufficient statistic model that we have in this paper, it means that you need the curtices to be 180 times larger than the frequency for a 1% monetary policy shock. And I think it's hard to find distribution in the data for which you will get that. So another thing that I think will be possible to get that will be large shocks. And when you think about monetary policy, thinking about a change in monetary policy in interest rate or money supply that will induce 80% change in nominal wages or like interest rate is very unlikely. And what I think and can also help explain what we see in terms of in the data in terms of the CPI will be able to open the economy and think about exchange rate. Exchange rate, as we know, I mean, Oleg just said that for some, now it doesn't follow a random walk, but when we look at exchange rate, we know that it used to follow a near random walk, and most model couldn't beat the random walk. So we can think about an open economy version of this model in which we will have now an exchange rate that will follow a Brownian process and have large shocks. And what I think here is that this will have implication for the adjustment of the price of imported good and can help reconcile what we see in the data for the CPI versus the PPI. So the data is consistent with the PPI, but not the CPI. So to give you another intuition, very briefly, about why I think the CPI can, using exchange rate and opening up the economy can work in this case, is that we have a couple of results from Gopinath and Itsuki earlier paper when it comes to the effect of exchange rate on pass-through to prices, and we know that exchange rate can be large. So one thing is that what they show in one of the papers is that the pass-through of high frequency price adjustment is more than twice the one that we see for low price adjusters. So what it implies is that actually, if you write an open economy model version of the mean cost model, and you assume that you have a Kimball aggregator on the household side, it's possible to generate a case where the delta actually becomes endogenous and depends on the frequency of price changes. So for the other part of the CPI index, not the part that is produced domestically for the imported good, you can have a higher effect. The other thing is that the currency of invoicing matters. So if we think about a mean cost model in which firms now have to pay the mean cost, the price psi, which is random, but denominated in the unit of the currency of the country in which they sell the good. Then for France, for example, if you have a country like the US that is selling goods in France, they set the price, let's say in euros, and the mean cost that has to be paid in euros, and they have to convert that back in US dollar. So the exchange rate will have an impact, an implication on the frequency of price changes for the price of imported good, both at the dock and for the retailers, and that can also have implications. Because I don't have much time, I won't talk too much about the other implication that I think could happen if you think about sufficient statistic in the data. So I think we can compare also the pass-through, and when you think about open economy and price of imported goods, you have different type of prices that you can think of. And the last thing that I wanted to talk about, I think I'm out of time, right? Yeah. So, well, yeah, I want to talk about future monetary policy shocks, but we can talk about that later. So, thank you.
Fabrizio.
A great paper and great discussion. Quick question, Fernando. About so you show a bunch of models, and the sufficiency seems to be consistent with all these different models, which though have very different implications for monetary policy. So I was wondering, can you actually go further and tell you which model does better? Or because if it seems like a very general result, which is great, but maybe not so great if I want to know what model to use for monetary policy.
A great paper and discussion. I have a similar question to Fabrizio on the data side. Do you use only manufacturing? Question.
Sorry,
That's okay.
The sound was coming. Should I accumulate it?
Yes. Okay, so it wasn't clear, but if you use only manufacturing, I don't think then those regressions are really testing what you're doing. That's going to be a super small part of the CPI in any country, and then the story is really going to be on the other side. And both in terms of the sector's weight, and we know from Jen's work, it's going to be very small, and also the frequency of the price adjustment. So in that sense, I think there's a big disconnect between your model and the empirical exercise.
Okay, Fernando.
All right, so, sorry. So first, thanks a lot for the great discussion. Okay, it was good that it happened to you. Yeah. Just stay here. I'm moving in. So thanks a lot for a great discussion. So it was very, very clear. I should have just installed the slides. So yeah, so I just had to say I'm totally on board with everything. So these things I was just trying to say much less articulate that sales. So if you look at something like the paper by Eichelman et al., in some sectors, and this actually had to do with the second question too, in some sectors you see that you have prices that go up and down and they repeat the same one, and they have a particular model. So for the CPI, that's actually not true for the PPI, but it's true for the CPI. And in this model, that doesn't happen because you close the gap. Now, we did write a paper in the AHA macro where we show actually we solve what is sufficient statistic for that model, and we show the difference between the two. So anyway, I encourage you to have like a non-zero set of readers to take a look at that one. But it's exactly that. So, okay, and then fantastic suggestion with exchange rate. They look great. They are kind of random walkish. They may be easier to do something that is more exogenous. You could also go close to the dock where there is less sales or anything. So I think it's a great suggestion and we should pursue it. And one more thing about that, that's another very good point, large versus small shocks. So these were all approximations with small shocks. Notice that for small shocks, actually, the frequency of price changes doesn't change. That's something that is not appreciated. It's true in all these models. Jen gave a great discussion where she shows that in one of these models. So what it changes in different models is how many are increases and how many are decreases. But for small shocks, the total number of price changes stays constant. That's a theorem. Okay, now, large shocks, it's a different matter. For large shocks, then what happens is that you do change. And I encourage you, there's a very nice paper now coming out in the Insights by Francesco Lippi, by Alberto Cavallo, and Kevin Miyahara, I may pronounce the last name. And what they do is they look at the experience, recent experience, where we seem to have large shocks, and they show that the frequency does change, and they see what happens. And that's the advantage of the state-dependent models, that they could address that. And in terms of sectors, no, of course, we use all the sectors, because a lot of the macro otherwise is talking about, I'm totally guilty of it, is making theories about the price of Coke. Because, you have, scanner price data, which is about Coke and, or gasoline, exactly. That's why that's kind of like, okay, fine. But, we want to know something about the CPI and the PPR from all the sectors. Of course, you are stretching that the models may be different, but that's why we use all the sectors, and that's why I don't like to use fixed effects within, even though, whatever. So, yes, totally on board with that. But of course, then it's more heroic to think that you have posted prices for all the goods. And then on Fabrizio, if you actually were to do things like what Mike was doing, you get that, depending on what you look at it, they have exactly the same, with the same kurtosis and frequency, these type of shocks, they give you the same implication. All this, for instance, you could take like, I think at least I'm more insider, so I understood. He was given an example in which you have the same kurtosis or frequency, when a model where you have multiple goods, kind of like Virgilio and asteroids, versus a model that is Nakamura and Steinson with a lot of Calbones. They give you the same kurtosis and frequency, they give you the same impulse response, the same area on the impulse response. So it's kind of, that's sort of similar. Well, at first order, it's the same if you look at the area under it. And large shocks is different, and other shocks in which you have, anyway, some other issues are different. But for this particular one, you cannot distinguish based on that. But anyway, mostly, again, I just want to thank for a great discussion.
And we saved 2 minutes.